Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive right in. Today, we're going to unpack a framework that has stood the test of time in the world of finance. I'm talking about the value investing blueprint from the legends themselves, Benjamin Graham and David Dodd. Now, you might think something cooked up in the 1930s is a bit dated, but trust me, its fact-based approach is more relevant than ever for navigating the wild markets we see today. And it all kicks off by asking one really smart question.
So let me ask you that. What do you think is the absolute biggest risk to your money? I mean, the obvious answer is buying a stock that just completely craters, right? A company that goes belly up. That seems like the worst case scenario. But what Graham and Dodd figured out is that the real danger, the one that gets most people, is actually something a lot sneakier, and in the long run, a whole lot more expensive.
And that idea brings us to the very first pillar of their entire philosophy. See, if you want to invest safely, you've got to understand the two main threats you're up against every single time you click that buy button. And getting this right, well, it changes your entire perspective.
So here's how they broke it down. On one side, you've got what they called quality risk. That's the big, scary monster, the company going bankrupt. It's dramatic, it's what you see in the headlines. But then on the other side, you have the real villain of the story, price risk. And this is just, well, it's the simple act of paying too much for a perfectly fine, even a great company. The genius insight here was realizing that while quality risk feels terrifying, it's actually price risk that quietly, consistently destroys more fortunes over time. So the big takeaway is this. Your number one job isn't just to avoid bad companies, it's to avoid paying a bad price for good ones.
Okay, so if overpaying is the primary enemy, how in the world do we defend against it? Well, Graham and Dodd's entire system was built on a foundation of solid, cold, hard facts, totally ignoring the noise and the hype of Wall Street forecasts and speculation. The core principle here is just so simple, but it's incredibly powerful. You have to give the most weight to the information you are most certain about. That means you're laser-focused on the numbers you can actually verify in a company's financial statements. You know, what is, not on what some analyst predicts or what the market sentiment is, or some exciting story about what might happen 5 years from now.
And this old saying just nails it. Think about it. A company's reported profit can be wiggled around with all sorts of accounting rules and assumptions. It's kind of like an interpretation of what happened. But cash, the actual physical cash coming in and going out to pay the bills, to buy new equipment, to pay salaries, that is a whole lot harder to fake. It's a fact. And for a true value investor, the whole analysis has to start with the facts. And the most fundamental fact you can find on a balance sheet is something called book value. The easiest way to think about it is like this. Imagine the company has a giant everything must go sale. They sell off every factory, every truck, every piece of inventory. They collect all that cash. Then they use that cash pile to pay off every single one of their debts. Whatever's left over, that is the book value. It's the tangible, rock-solid net worth of the business. And for a value investor, this number is your ultimate anchor to reality. It's always where you start.
So, with that solid foundation of facts in place, let's get into the actual tools Graham and Dodd used to dig through those numbers and find real value. You can think of these ratios as a quick financial health check, kind of like a stress test for the company. The current ratio, for example, asks a really simple but vital question. If all your short-term bills came due tomorrow, do you have enough easily accessible stuff to pay them off? Graham and Dodd were pretty strict about this. They wanted to see a ratio over 2. That means the company has at least $2 of ready assets for every $1 it owes in the short term. That's a nice fat cushion. It tells you the business isn't living paycheck to paycheck.
Now, Graham took this idea even further with an ultra-conservative metric he called net working capital. And this is where the magic happens. You take only the company's most liquid assets. We're talking cash, inventory, what customers owe them. And from that, you subtract all of its debts, short-term and long-term, the whole shebang. Now, if you could find a stock that was trading for less than that number, well, it was like buying the business for less than its liquidation value and getting all the long-term stuff, the factories, the brands, the real estate, for absolutely free. It was the ultimate undeniable bargain.
And what's so cool about this way of thinking is that it's not just for stocks. It gives you a really powerful lens for looking at all kinds of investments, including the other side of the company's books, its debt. You know, the mindsets of a stock investor and a bond investor are kind of like mirror images of each other. The bond investor, who's really just lending the company money, wants to see this huge cushion of owner's equity underneath them. Why? Because that equity is their protection. But the equity investor, the stockholder, they get whatever profits are left over. So they want to see a reasonable amount of debt so the company can survive the tough times and really fly during the good ones. A healthy company is good for both, but they're definitely looking at it from opposite sides of the coin.
So when a value investor is hunting for bargains in the bond market, they often look for something called fallen angels. These are bonds from companies that used to be the gold standard, highly rated, but then they hit a rough patch and got downgraded. The key insight here is the human element. A once great company often has a management team that is deeply personally motivated and probably a little embarrassed to regain its former glory. They're going to fight tooth and nail to get that high rating back, which gives you a potential edge over a company whose bonds were considered junk from day one.
So, we have the principles, we've got the tools. But Graham and Dodd were crystal clear that none of it matters if you don't have the right psychological mindset. Honestly, this might be the most important piece of the entire puzzle.
And to show you the single biggest mental trap in investing, the book uses this really powerful analogy, and it's about a small, furry animal.
I mean, what a perfect picture of herd mentality, right? Lemmings are usually just doing their own thing. But when things get crazy, they stop thinking for themselves, they form this massive herd, and they just follow. And investors who are normally rational people can do the exact same thing. When fear or greed takes over the market, they abandon their own research, they abandon their own judgment just to run with the pack. And as you can see, it's often right off a cliff. The whole game for value investor is having the discipline to stand apart from that herd and just stick to the facts, no matter how lonely it feels.
And all of this, every single thing we've talked about, leads us to the final and, without a doubt, the most essential concept in the entire Graham and Dodd philosophy. This is the big one. It's the central idea that protects you from all those dangers we mentioned, price risk, bad luck, and even from your own emotions.
Margin of safety. If you remember nothing else, remember those 3 words. It's not just a number on a spreadsheet, it is a discipline. It is the deliberate, conscious act of buying something for way less than your careful, conservative analysis says it's actually worth. That gap, that discount between price and value, that is your shield. If your math is a little off, if the economy zigs when you thought it would zag, if the company hits a speed bump, the margin of safety is the cushion that absorbs the blow and protects your money.
Let's make this super simple. Let's say you've done all your homework, you've run the numbers, and you've calculated that one share of this company is worth about $50. A value investor doesn't buy it at 49. You don't even buy it at 40. You wait patiently for the market to get pessimistic and offer it to you for, say, $30. That $20 difference, that's not just your potential profit. That is your margin of safety. It's the bedrock on which all successful long-term investing is really built.
And so that brings us right back to the beginning. I want you to take a hard look at your own investments. Are they built on forecasts and speculation? On the hope that the future is going to play out exactly the way you think it will? Or are they built on a solid foundation of fact, purchased with a significant margin of safety that protects you from a future that is, and always will be, uncertain? It's a question every single one of us needs to answer.
All right, let's dive right in. We're going to talk about a set of investing rules that were literally forged in the fire of the 1929 market crash. Now, they're almost a century old, but you know what? They offer one of the most powerful, most crucial lessons for any investor today: how to build a real safety net to protect your money.
Just think about that for a second, because that is exactly what happened. The absolute financial chaos of the late 20s and early 30s, it forced a complete top-to-bottom rethinking of what it even means to invest. And it led to a philosophy built not on hope or a hot tip, but on a deep, analytical safety net. So this number, this was the peak, October 1929. After a whole decade of a roaring bull market, the roaring 20s, right? The Dow Jones Industrial Average hit this all-time high. Credit was easy, optimism was just off the charts. It really felt like the party would never, ever stop.
And this was the bottom. By 1932, the market had collapsed to this just sickening low. We're talking nearly 90% of its value just gone. Fortunes were wiped out overnight. It was a financial apocalypse that left people wondering if there was any logic to the markets at all.
But out of that wreckage, out of that crucible of financial pain, a new way of thinking was born. This wasn't just about picking hot stocks anymore. This was about survival. It was about finding a rational, repeatable way to figure out what a business was actually worth in a world that had seemingly gone mad.
So what on earth went wrong?
Well, the market had basically become a casino. The price you paid for a stock had become completely untethered from the value of the actual real-world company behind it. It was all just speculation, driven by mood, momentum, and hype. The crash violently reconnected that link between price and value. And a couple of pioneers saw an opportunity to make that connection permanent.
In 1934, right in the middle of all that wreckage, two guys, Benjamin Graham and David Dodd, started asking a truly revolutionary question. They asked, what would a reasonable business owner, not a gambler, not a trader, pay for this entire company? What price would almost guarantee you get your money back with a pretty good shot at a profit? I mean, this question, it shifted the entire paradigm.
And that whole line of questioning, it led them to their single most important concept. This is the bedrock of their entire philosophy. It's the big idea that would go on to influence generations of investors, including some of the greatest of all time. They called it the margin of safety.
So what is it? The margin of safety is your buffer. It's your cushion against all the uncertainties of the future. It's protection against bad luck, protection against errors in your own judgment, because we all make them, and protection against the wild emotional swings of the market. It's the ultimate defense. Okay, let's break it down with a super simple example. First, you got to do the hard work. You analyze the business, you look at its assets, its earnings power, its stability, and you calculate what you believe its intrinsic or its true underlying value is. So for this example, let's just say you arrive at a nice round figure of $100. Okay, next step, you look at the price tag the market has put on that exact same business. And what do you find? In this case, the stock is trading for just $50. That's a huge discount to what you believe it's actually worth. And that $50 difference between the $100 value and the $50 price, that's it. That is your margin of safety. Now, here's what's so powerful about this. Your valuation, your $100 estimate, it could be off. It could be off by 10, 20, even 30%, and you still wouldn't lose your initial $50. That is some serious protection. See, Graham and Dodd understood that investors really face two main kinds of risk. There's quality risk. That's the one we always think about. Buying a company that just goes bankrupt. It's dramatic for sure, but it's actually pretty rare. The far more common and ultimately more costly danger for most of us is price risk. Simply paying too much for a perfectly good company. The margin of safety is designed specifically to fight that price risk.
And nothing, I mean nothing, captures this defensive mindset better than Graham's most famous quote. This isn't about hitting home runs, it's about not striking out. It's about preserving your capital first, last, and always. The idea is, the gains will take care of themselves if you can just avoid the big, catastrophic losses. So how did they actually find these incredible bargains? Well, it wasn't just guesswork or gut feeling. They developed a very specific, almost mechanical blueprint, a set of really tough criteria designed to unearth companies that were trading with a massive margin of safety.
Now just look at how strict these rules were. I mean, wow, they wanted companies trading for less than their net assets. Even better, some were so dirt cheap that their entire market value is less than their working capital. Think about that. You were basically getting the factory and all the equipment for free. You add in consistent profitability, a solid dividend, and a high earnings yield compared to bonds, and you had an ironclad case. Honestly, very few companies today could pass all these tests at once. That last point, the earnings yield, is really crucial. It sounds kind of old-fashioned today, but it's just the inverse of the PE ratio you always hear about. And the genius of it was that it allowed Graham and Dodd to directly compare the return they could get from a stock to the much safer return they could get from a high-quality corporate bond. It forced this incredible discipline of only buying stocks when they offered a significantly higher potential return to compensate you for taking on that extra risk. Of course, the world has changed a lot since the 1930s. I mean, that's an understatement, right? The economy is different, financial reporting is different, and while that core principle of demanding a margin of safety is absolutely timeless, the specific rules of the playbook, well, they've had to evolve. You see, a direct copy and paste of the old rules just doesn't work today. The economy has shifted from a brick-and-mortar world, where value is really obvious on a balance sheet, to an information economy, where value lies in things you can't touch, like brands and software. Plus, financial reporting today is way more detailed, which lets you get a much deeper look into a company's real earnings power. So what do modern value investors do? They adapt. They keep the spirit of the law, even if they change the letter. They might be even tougher on debt, for example. They'll look at cash flow instead of just the accounting profit. They recognize the incredible value of those intangible assets. And critically, they understand that a fantastic, fast-growing company might wisely choose to reinvest its profits for future growth instead of just paying them all out as a dividend.
And the proof of this philosophy's power, well, it's in its legacy. It has created an unbelievable amount of wealth for those who have followed its core principles. And there's no better example of that than its most famous student.
Warren Buffett, of course. He started his career as a pure Graham and Dodd disciple. He bought these statistically cheap, what he called cigar butt companies, like the original Berkshire Hathaway. And you can see his purchase of the Washington Post was a classic straight-down-the-middle margin of safety play. But he evolved. He began to focus not just on price, but on the quality of the business and its management, which led to game-changing investments like Coca-Cola.
This quote just perfectly captures his whole evolution. He realized that the greatest margin of safety doesn't always come from buying cheap assets on the balance sheet. Sometimes, the best protection comes from owning a truly exceptional business, one with a powerful, durable competitive advantage, even if you have to pay a fair and not a rock-bottom price for it.
Maybe Graham's most brilliant contribution was this simple mental model. He tells you to think of the stock market not as some all-knowing judge, but as your manic depressive business partner, Mr. Market. Some days he's euphoric, he's ecstatic, and he offers you absurdly high prices for your shares. Other days he's terrified and offers to sell you his shares for pennies on the dollar. And your job is not to be influenced by his crazy mood swings, but to take advantage of them.
And that's really the ultimate takeaway, isn't it? The Graham and Dodd philosophy isn't just a set of dusty old rules. It's a framework for rational behavior in what is often a very irrational world. It's about doing the hard work to understand what a business is truly worth, so that when Mr. Market comes knocking with a crazy offer, either panicked or euphoric, you're the one in control.
All right, welcome to The Explainer. Today, we're going to jump right into one of the biggest, most fundamental debates in all of finance: value versus growth. It's a question that has literally shaped fortunes and defined legendary investors for decades. And it really boils down to this, right? Do you go all in on a company that's just exploding, thinking its future is so bright it's worth paying a premium today? Or do you play the detective, hunting for a solid, maybe kind of boring company that nobody's paying attention to, just waiting for that perfect bargain price? All right, so let's get into it. To really wrap our heads around this, we're going to build this thing from the ground up. We'll start with the absolute basics, then we'll talk about how time itself changes the value of money, figure out how to give a company a report card, and then finally, we'll put these two big ideas head to head. Okay, so first things first, before we can even get into the weeds on strategy, we've got to make sure we're all on the same page, speaking the same language. At the end of the day, when you invest your money, you've really got two main paths you can take. You can buy equity, which we all know is stocks, and that makes you a part owner of the business, or you can buy its debt, like bonds, where you're basically the lender. So think of it this way. You can own a slice of the pie, or you can be the person the bakery owes money to. Okay, now this is where it gets really interesting. This idea comes from the godfather of value investing himself, Benjamin Graham. He suggested that maybe we should look at a stock with the same tough analysis we use for a bond. A bond's value is pretty straightforward, right? You know what it pays? Graham's big revolutionary concept was that a stock also has a real, fundamental, calculable value, and that value can be completely different from its wild up and down price on any given day. And that idea? That's the cornerstone of everything we call value investing. So, to even begin to figure out what that intrinsic value is, we first have to get our heads around a concept that is, no joke, the foundation of all finance, and that is the time value of money. So future value, this is all about what Einstein supposedly called the eighth wonder of the world, compounding interest. It answers a really simple but super powerful question. If I invest this chunk of cash today, what's it actually going to be worth years from now? So let's just walk through this, right? Year one, you make $50 on your grant. Easy. But check out year two. Now you're making 5% on 1,000 times $50. That extra couple of bucks might not sound like a big deal, but when you stretch that out over 20, 30, 40 years, that process of earning money on your money becomes this unstoppable force, a real engine for building serious wealth. And present value? Well, it just flips the whole thing right on its head. It asks, okay, I want to be a millionaire when I retire. How much do I need to sock away right now to make that dream a reality? It's a super important tool because it lets us take all those potential future profits of a company and figure out what they're worth to us in today's dollars. All right, let's start tying these threads together. Now that we've got this idea of the time value of money, we can use it to actually grade a business, to peek under the hood and see if it's a healthy, solid company that's worth our hard-earned cash. You know, when you crack open a company's financial reports, you're basically putting on your detective hat, and you're looking for clues in three main spots. First up, liquidity. Can they pay the bills that are due like next month? Second, solvency. What about their huge long-term debts? Can they handle those? And finally, the big one, profitability. After everything is said and done, are they actually making any money? Now, when it comes to profitability, there are a ton of ways to measure it. But one of the real heavy hitters is called return on equity, or ROE. The best way to think about it is this. For every single dollar the owners have put into the business, how much profit is the management squeezing out? A lot of the pros, they look for companies that are consistently hitting an ROE of 15% or more. That's usually a pretty solid sign of a business that really knows what it's doing. And look, this isn't just some abstract financial theory. You can find the actual numbers for this stuff right inside a company's annual report, in a table that looks something like this, the Statement of Shareholders' Equity. Now, don't squint trying to read the tiny print. The only thing you need to know is that this is where the treasure is buried. This is where you find the official numbers for net income and equity, exactly what you need to calculate that super important ROE. All right, we've got the basics down. We understand stocks, we get the time value of money, and we know how to check a company's vital signs. So with all that in our toolkit, we can finally step into the ring for the main event, the big showdown between value and growth. Okay, check this out. Let's just imagine a company. Its book value, its official worth on paper, is $10 a share. Now, look what happens. If the stock is trading for $15, you're obviously paying a premium. But if the market's down on it and it's trading for $6, you're getting it at a serious discount. But here's the kicker. Look at what that does to your dividend yield, your actual cash-in-hand return. The cheaper you buy the stock, the higher your return is on the exact same dividend payment. That is huge. And that, right there, that gets us to the very soul of this whole debate. The growth investor, they're a futurist. They're trying to find the next Amazon, the next big thing, and they are more than willing to pay a high price today because they're betting that incredible future growth will make today's price look like a steal. But the value investor, they're a pragmatist, a bargain shopper. They are deeply skeptical of those pie-in-the-sky forecasts. For them, the price you pay is everything. So yeah, the growth investor is chasing that hot tech startup, while the value investor is over here quietly poring over the balance sheet of a company that makes something, well, a lot more boring, but a lot more predictable. When you strip it all the way, it really comes down to your personal worldview. The growth investor has to believe that the world is pretty predictable, that earnings will just keep chugging along up and to the right. The value investor, on the other hand, thinks the world is a messy, chaotic place. But, and this is the key, they believe that very chaos is what creates the panic and fear that leads to the incredible bargains they live for. So you've got these two completely opposite ways of looking at the market. Which one's right? Well, when in doubt, it's always a good idea to see what history and some of the smartest people to ever play this game have to say about it. And this brings us to what is, without a doubt, the most famous quote in the world of investing. What Graham was saying is that in the short run, the stock market is just a popularity contest. It's all about hype, tweets, news headlines, and emotions. But in the long run, all that noise fades away, and the market becomes a weighing machine. It doesn't care about popularity. It cares about the actual, tangible substance of the business, its earnings, its assets, its true weight. And you know what? A lot of historical data actually backs this up. While growth stocks can give you that roller coaster thrill of a soaring price, value stocks have often, over the long haul, delivered a higher total return. And the reason is so simple but so powerful, that bigger dividend you get from day one. When you reinvest that cash year after year, it acts like a steady wind at your back, just compounding and compounding your wealth. It is so easy to get hypnotized by a stock price that's just blasting off to the moon. We all do it, but we forget what really builds wealth over a lifetime. It's often not the flashy price chart. It's the boring, steady, reliable cash dividends that companies pay out to their owners Cold, hard cash that you can turn around and use to buy even more of the business, firing up that compounding machine even faster. So this all leads to a really fantastic, practical piece of advice from a true legend, Vanguard's founder, John Bogle. He basically said, look, if you want to take a flyer on some speculative, high-growth stuff, go for it, have fun. But, he said, you should keep that play money to no more than 5% of your total portfolio. The other 95%, the real foundation of your financial future, should be built on something solid and reliable. And that really brings us back to the beginning, to a final question for you. When it's all said and done, when the short-term popularity contest is over and the long-term weighing begins, what is your portfolio really going to weigh? Is it going to be built on the hype of the moment or on the enduring substance of real value? That's a question only you can answer. All right, welcome. You've probably heard it 1,000 times. Fixed income? Bonds. That's the safe part of your portfolio, the anchor that keeps everything steady. But what if that's not the whole story? What if that safety we all count on is, well, a bit of a myth? Today, we're going to dig into that. We're going to challenge that core idea and really unpack what fixed income investing is all about, right from the very beginning. So why do we even think of bonds as being so safe? Well, you got to go way back. Think about the 1930s, right after that catastrophic stock market crash. People were, and I'm putting it lightly here, completely terrified of stocks. They ran for the hills, and where did they go? They took refuge in bonds. Because bonds offered something stocks just couldn't, a promise, a money-back guarantee that you'd get your money back when it matured. That feeling was so powerful, it basically became the investing rulebook for an entire generation. And that really gets to the heart of what we're talking about today. Because, look, while bonds are generally safer than stocks, they are absolutely not risk-free. Not by a long shot. They're tied to these huge economic forces that can make their values swing around in ways that might really surprise you. So, let's dive in and break down exactly what those forces are. All right, here's the game plan. We'll kick things off by poking some holes in that safe label. Then, we'll get into the nitty-gritty of U.S. Treasuries. They're the bedrock of this whole world. After that, we'll tackle the single most important concept, the price and yield seesaw. From there, we'll learn how to measure risk with a cool tool called duration, talk about the sneaky threat of inflation, and then we'll wrap it all up with some smart, practical strategies. Sound good? Let's go. Okay, so let's get right into it. This myth of absolute safety. Yeah, sure, a bond from a super reliable issuer has that money-back guarantee, but only if you hold it all the way to maturity. Anytime before that, its price on the open market can, and trust me, will, bounce around. It's actually exposed to some of the very same economic swings that affect stocks, and that's a wake-up call for a lot of people. And here's the real kicker. Even for the absolute safest of the safe, let's say you buy a U.S. Treasury bill today, the chance of the government not paying you back is practically zero. But what happens if interest rates go up tomorrow? All of a sudden, new bonds are being sold that pay more than your bond does. Your safe investment just became less attractive. And that's the fundamental problem, right? You have to make a choice to invest today, knowing that the world of interest rates will look different tomorrow. To really get a handle on any bond, you have to start with a benchmark, the gold standard that all other debt is measured against, U.S. Treasuries. These are considered risk-free in one specific way, default risk, because they're backed by the full faith and credit of the U.S. government. They are truly the foundation of the entire fixed income universe. Now, U.S. Treasuries come in 3 basic flavors. Over on the left, you've got Treasury bills, or T-bills. These are the short-term guys, maturing in a year or less. The way they work is you buy them for less than they're worth, say you pay $970, and when they mature, you get the full $1,000 back. Simple. On the right, you have notes and bonds. They're for the longer haul, and they work differently. They actually pay you interest payments along the way, we call those coupons, and then give you the full face value back at the very end. And that word, coupon, it actually has a pretty cool origin. It comes from back in the day when bonds were actual paper certificates, and attached to them were these little physical coupons. To get your interest payment, you'd literally have to clip off a coupon with scissors and hand it in. Now it's all digital, of course, but the name stuck. So if you have a $10,000 bond with an 8% coupon rate, that means you're getting $800 a year in interest, usually split into 2 payments of $400 each. Okay, lean in for this next part. This is absolutely essential. If you only remember one single thing from our chat today, make it this. Understanding this push and pull between a bond's price and its yield, well, that's the key that unlocks the entire bond market.
It's a simple dynamic, almost like a law of physics, and it drives everything.
It's really this simple. They move in opposite directions, just like a seesaw. Picture this. You own a bond that pays you a 4% coupon. Pretty good. But then, whoops, the Fed raises interest rates, and suddenly brand new bonds are being issued that pay 6%. Now, who in their right mind is going to buy your 4% bond for full price when they can get a shiny new one paying 6%? Nobody. The only way to sell your bond is to lower the price, to sell it at a discount. And of course, the opposite is true. If rates fall to 2%, your 4% bond looks like a rock star, and its price is going to go up. And here's what that looks like in dollars and cents. Let's use this example. A 5-year, $10,000 bond that pays an 8% coupon. If the current interest rate out in the market is also 8%, then your bond is worth exactly what you paid for it, 10 grand. But if market rates drop to 6%, your 8% bond is suddenly a hot commodity. The present value of all its future payments jumps to over $10,800. But if market rates spike up to 10%, well, now your 8% bond is less attractive, and its value drops to just over $9,200. It's the same exact bond, making the same exact payments. The only thing that changed was the world around it.
This brings us to 3 really important terms. If a bond is selling for its original face value, like that middle example, we say it's selling at par. If interest rates in the market are higher than your bond's coupon, its price has to fall to compete, so it sells at a discount. And if market rates are lower, making your bond's coupon look extra juicy, its price will rise above face value, and it sells at a premium. Simple as that.
So we know a bond's price is going to move when interest rates change. The big question is, by how much? Is it a little nudge or a giant leap? Well, it turns out there's actually a way to measure this sensitivity, and that's where this concept called duration comes in. Now, I know, the name Macaulay duration sounds super technical and maybe a little intimidating, but the idea behind it is actually pretty intuitive. It's not just about how many years are left on the clock until the bond matures. Instead, think of it as the weighted average time it takes for you to get your money back in today's dollars. I love this analogy. It's like the bond's financial center of gravity, the balancing point for all the money it's ever going to pay you. So how do we find this center of gravity? You don't need to do the math, but just so you get the idea. First, you'd list out every single payment the bond is ever going to make, every coupon payment, plus the final principal. Second, you figure out the present value of each of those payments, because $1 today is worth more than $1 10 years from now. And third, you find the weighted average time, where the bigger, sooner payments get more weight. See? A bond that pays a huge coupon gets more of your money back to you faster, so it will have a shorter duration. And here is the so what. Here's why you should care. Duration is basically your risk meter for interest rates. A good rule of thumb is that for every 1% change in interest rates, a bond's price is going to move in the opposite direction by about its duration in percent. So a bond with a duration of 5 years, if rates go up 1%, its price will drop by about 5%. But as you can see here, a long-term bond, like a 30-year bond, is wildly sensitive. A simple 1% rate hike could just hammer its price, causing it to drop by almost 30%. That's why duration is so critical to understand. Okay, so we've talked about market risk, that seesaw effect from changing interest rates, but there's another risk, a much sneakier one, that every bond investor has to worry about: inflation. Think of it as a silent thief that can slowly eat away at the value of your returns, even if the number of dollars you get back is guaranteed. Let's just ask the question straight up. Let's say you buy a bond and you're earning a 3% coupon. You're feeling pretty good about that. But then, over the course of the year, inflation runs at 5%. So what just happened? Well, on paper, you made 3%. But in terms of what your money can actually buy, your real purchasing power, you've actually gone backward. You've lost 2%. That's the trap of confusing your nominal return with your real return. And listen, this isn't just some textbook theory. This has happened in a big, painful way. Back in the 1960s, people were happy to buy U.S. Treasury bonds paying less than 5%. Seemed like the safest thing in the world. Then the 1970s hit, and inflation just went through the roof. The people holding those old, low-coupon bonds got absolutely crushed. Not only did the market price of their bonds tank because of rising rates, but the money they eventually got back was worth a tiny fraction of what it was when they first invested it. So, to fight this very problem, the U.S. Treasury came up with a pretty clever solution: TIPS, or Treasury Inflation Protected Securities. These are designed specifically to protect you from that inflation risk. It's really smart how they work.
The interest rate on the bond is fixed, but the principal, the amount you get back at the end, is adjusted up or down based on the Consumer Price Index, which is the government's main measure of inflation. So if inflation goes up, the value of your bond goes up right along with it, protecting your real return. Okay, we've gone over the instruments, the core mechanics of how they work, and the big risks to watch out for. So now, let's put it all together. Let's talk about some real, practical strategies that any investor can use to manage these risks and invest in bonds the smart way. This is your playbook. Let's start by recapping 5 key rules of thumb. These are the big takeaways. Number 1, the seesaw. Prices and yields move in opposite directions, always. 2, bigger coupons mean you get your money back faster, which means a shorter, less risky duration. 3, duration is almost always shorter than the maturity date. 4, longer maturity usually means longer duration, more risk. And 5, longer duration means much, much more sensitivity to interest rate changes. Burn these into your brain. Now that leads us to a really common and really smart strategy called laddering. It's simple, but it's powerful. Instead of taking all your money and dumping it into one 5-year bond, you split it up. You buy a 1-year bond, a 2-year bond, a 3-year, a 4-year, and a 5-year. Now, you have a piece of your portfolio maturing every single year. This does 2 amazing things for you. It gives you a steady stream of cash, and, this is the important part, it keeps you from betting the whole farm on one single interest rate at one moment in time. You're spreading your risk out over time. And that brings us to the final and maybe most important shift in how you should think about all this, especially if you're a regular investor. You can drive yourself crazy trying to guess where interest rates are headed so you can make a quick buck on bond prices. But that's a speculator's game. Your goal shouldn't be to ask the speculator's question. Instead, the source material really encourages us to ask the value investor's question. Think about it. A bond is a contract. It's a promise to pay you a specific amount of money on a specific date in the future. You already know its final value, so the focus shifts. It's not about predicting the unpredictable future price. It's about buying that future promise for as cheap as you can possibly get it today to maximize your return. How low can I get it? Asking that question changes the entire game. It moves you from speculation to value, and honestly, that's the best foundation for any investment strategy.
All right, let's talk about corporate bonds. You know, for a lot of people, that term brings up these images of complicated Wall Street stuff, something that's maybe best left to the pros. But here's the thing, it doesn't have to be that way. With the right way of looking at them, a good framework, anyone can learn to analyze these things. So in this explainer, we're going to break it all down. We're going to give you the essential tools you need to look at a corporate bond, not just as a casual investor, but with the really critical eye of an expert. Okay, so here's our roadmap. We're going to start with the absolute fundamentals, what these things even are. Then we're going to get our hands dirty and dive into financial statements. After that, we'll learn 3 really critical safety tests and see how they connect to the bond ratings you always hear about. We'll also dig into the huge difference between what you want as a bondholder and what a stockholder wants. And finally, we'll see if we can use all that knowledge to hunt for some real opportunities.
All right, Section 1, the basics. Look, before we can even think about analyzing a bond, we've got to go back to square one. What is it we're actually buying here? And maybe even more importantly, what is the number one risk, the biggest danger that we need to be watching out for?
So here is the single most important difference you have to grasp. When you buy a government bond, you're lending money to a government, which can literally print more money to pay you back. A corporation can't do that. No, a company has to go out into the real world, the messy, competitive marketplace, and earn the cash to pay you your interest and give you your money back. And that one simple fact introduces the biggest risk in the world of corporate bonds: credit risk, the simple, raw possibility that the business just doesn't make it, and you don't get paid back. I want you to think of this as the company's financial pecking order. If things go wrong, if the company gets into trouble, you, as a bondholder, are a lender. You are in line to get paid before any stockholder ever sees a single dime. But, and this is a really important but, you're usually standing in line behind the big banks that also lent the company money. Now the stockholders, they're the owners. They're at the very back of the line. They get paid last, if at all, but they also get all the potential reward, all the upside if the company totally crushes it. It's that classic risk-reward trade-off right there.
Okay, Section 2, decoding financial statements. So if we're going to figure out if a company can actually pay us back, we have to learn to speak its native language. And that language, my friends, is written in its financial statements. First up is the balance sheet.
Now, I want you to think of the balance sheet like a financial x-ray of a company, or maybe like a doctor's chart. It's not a video showing you what happened over the last year. It is a single, static snapshot. It shows you the company's financial health at one specific moment, totally frozen in time. It tells us with no ambiguity exactly what the company owns and who has a claim on all that stuff.
And this visualizes the core idea perfectly. It's like a scale that has to balance. On the left side, you have assets, everything the company owns, cash, inventory, factories, equipment. On the right side, you have who has a claim on those assets. The liabilities are what's owed to outsiders, like banks, suppliers, and you, the bondholder. And the equity? Well, that's what's left over for the insiders, the owners. It's what keeps the two sides perfectly balanced.
So, if the balance sheet is that snapshot, the income statement, well, that's the video. It shows you the company's performance, right? Its revenues, its expenses, all tallied up over a period of time like a quarter or a full year. And for us, as bond investors, there is one line item on there that is more important than almost any other. It's called EBIT. That stands for earnings before interest and taxes. And why do we care so much? Because that is the pot of money, the operating profit, that our interest payments are going to come out of.
Okay, Section 3. This is where the rubber really meets the road. We know where to find the numbers now, so let's get into the practical application. We are going to use 3 specific calculations, 3 key safety measures, to actually quantify a bond's risk, and just cut through all the noise.
These 3 measures, when you put them together, give you this powerful 360-degree view of how safe a bond really is. First, we're going to measure its leverage, how much debt it's using, with debt to total capital. Second, we're going to test its ability to pay its bills, its liquidity, with times interest earned. And finally, we are going to gauge how profitable the underlying business really is with pre-tax return on capital. Let's break them down.
Our first test is debt to total capital. This is a classic, old-school test of solvency. It answers a really simple question. How much of this company's entire operation is being propped up by borrowed money? It's pretty easy to calculate. You just take the company's long-term debt and divide it by the total capital, which is just that same debt plus all the shareholders' equity. It gives you a direct, clear percentage of its leverage.
So what's a good number? What should you be looking for? This chart gives us some really solid guideposts. Ideally, as a conservative investor, you want to see this ratio below 35, maybe 40%. That tells you the company has a conservative capital structure. Now, once a company hits 50%, meaning that fully half of its funding is from debt, that's generally seen as the absolute outer limit of what's acceptable. Anything above that, and you are definitely wandering into high-risk territory.
Okay, our second key measure, times interest earned. You might also hear this called the interest coverage ratio. And this is a total gut check on a company's short-term financial health. We take that super important number we talked about, EBIT, from the income statement, and we just divide it by the company's annual interest payments. The result tells us how many times over the company could pay its entire interest bill for the year using just its operating profits.
And again, what are we looking for here? You want to see a nice, big, healthy cushion. If the company's earnings cover its interest bills 6 or 7 times, or even more, you should feel pretty good about that. A moderate level of coverage is in that 4 to 5 times range. But if a company is only earning enough to cover its interest 2 times or less, that's really considered inadequate. It just means there's no margin of safety, no room for error if business suddenly takes a turn for the worse.
Now for our third measure. And to understand this one, we're going to look at a bit of a cautionary tale. This is the company Baldwin United, back in 1982. On the surface, they reported a huge net profit. Looks great, right? But buried deep in the footnotes of their financial statements was this terrifying little detail. Interest not covered. Now, how is that even possible? How can you have a huge profit but not be able to cover your interest? This is where our third test, pre-tax return on total capital, is so critical. See, it shows you how much real profit the business generates from all the money tied up in it. For Baldwin, that number was actually negative. The profit they reported came from sneaky accounting games, not from actually selling pianos and insurance. The core business was a total dud.
And this leads us to a really crucial insight from Warren Buffett. He points out that, look, a company that's struggling because the economy is tough, that's one thing. That happens. But a company that's in trouble because its management is consciously using accounting tricks to hide a fundamentally broken business model, that is a whole different level of danger. And that pre-tax return on capital metric we just talked about, it would have exposed that willful deception at Baldwin United, long before the company finally went bankrupt.
All right, Section 4, the spectrum of bond ratings. So we've just learned about these key safety ratios.
How does all of that translate into the real world? Well, they are the direct inputs that the big rating agencies use to come up with those letter grades, AAA, BB, C, and all the rest that you see assigned to bonds.
So the rating agencies basically create two big buckets. First, you have what's called investment-grade bonds. These run all the way from the absolute highest AAA rating down to BBB, and generally, these are considered safe enough for most conservative investors. Then everything below that grade is what's known as high yield, or, to be a little more blunt, junk bonds. These are rated BB and below, and they are considered speculative investments where there's a very real risk of default.
And this table just brilliantly illustrates the direct link between those numbers we just learned and the final ratings. Just look at this. A top-tier AAA-rated company covers its interest payments more than 15 times over, and it has less than 15% debt in its entire capital structure. Now just follow the chart down. An A-rated company has coverage of maybe 4 to 5 times. That's that moderate level we talked about. By the time you get down to a B-rated junk bond, the interest coverage is hovering somewhere between 0 and 1, and debt makes up over half of the company's capital. You can literally watch the safety margins just evaporate.
Okay, Section 5, bondholder versus stockholder. Now, this next concept is maybe the most important mental shift you need to make to be a successful bond investor. And it's this: your goals are not the same as a stockholder's goals. In fact, a lot of the time, they're in direct conflict.
This slide just lays it out perfectly. As a bondholder, what's your best-case scenario? It's getting your interest payments on time and getting your principal back when the bond matures. Your return is capped. It's fixed. Because of that, your number one priority is safety. A stockholder, on the other hand, has unlimited upside potential. They want the company to grow as fast as humanly possible. So they are often thrilled to see the company take on massive amounts of debt, your money, to fund some risky expansion project. Because, hey, if it pays off, they get all the reward. While you, the bondholder, you just took on all that extra risk for absolutely no additional gain.
And that brings us to our final section: spotting value in discount bonds. Now that we have a really solid handle on how to identify risk, we can actually flip that knowledge on its head and use it to find unique opportunities. Because, sometimes the market just gets the risk wrong.
And this brings us to this really cool idea of fallen angels. What are they? These are bonds from companies that used to be solid, blue-chip, investment-grade businesses, but they've fallen on hard times and gotten downgraded by the rating agencies. Now, the legendary investors Graham and Dodd pointed out that there can be real value hiding here. And why is that? Because a company that was once respectable often has a management team that is deeply personally motivated to get that investment-grade status back. And what does that mean? It means they're going to be focused on paying down debt and strengthening the balance sheet, which is exactly what you want to see as a bondholder.
So we have covered a lot of ground today. But if you remember one thing, it should be this: you have to approach corporate bonds with a healthy dose of skepticism. A high yield is never, ever a gift. It's a warning sign. It's the market screaming at you that there is risk involved. But now you have the tools to pull back the curtain, to look past that tempting yield, and to ask the one question that really separates the amateur from the pro. What is the hidden risk here, and am I actually being paid enough to take it? Answering that question, well, that's the key to investing with real confidence.
Welcome to The Explainer. Today, we are diving headfirst into the high-stakes world of distressed fixed income. This is that corner of the market where, if you're smart and maybe a little lucky, you can make a fortune. But get it wrong, you can get completely wiped out. It's all about digging into companies that are on the brink of financial ruin. So, before we get into the weeds, let me ask you something, and it might hit a little closer to home than you'd think. When you hear distressed debt, you probably picture some Wall Street hotshot, right? But what if I told you that the ripples from this world could reach all the way into your own retirement fund? Stick with me, because it's more common than you'd imagine. All right, to really get a handle on this, we're going to break it down. First, we'll talk about why this stuff actually matters to you. Then we'll get into the nitty-gritty of bankruptcy and workouts, the rules of the game. We'll even look at how the master, Warren Buffett, has played in this space. After that, we become financial detectives, focusing on cash flow. We'll learn how to spot the big red flags, and finally, we'll zoom out and see what happens when it's not just a company, but an entire country that goes bust. Okay, let's jump right in. Why should a regular investor, maybe someone like you, care about this seemingly niche topic? Well, the answer might surprise you. It might already be in your portfolio. First off, let's get on the same page. When we say distressed fixed income, we're talking about the bonds, the debt of companies that are really, truly in trouble. We mean they're either in bankruptcy, about to file, or are fighting for their corporate lives to avoid it. These are companies teetering on the financial brink. So how in the world does this risky stuff end up in your 401k? Well, it's a really strange quirk of the system. See, a lot of big bond mutual funds are designed to just track a major index. If a company's bonds are in that index, the fund manager often feels like they have to buy them. It's because they are more scared of doing worse than the index, that's bad relative performance, than they are of actually losing your money. Think about that. They'll accept a guaranteed small loss just to avoid the risk of a bigger tracking error. And just like that, you could be owning the debt of a failing company without having a clue. All right, let's pull back the curtain on what actually happens when a company gets into this much trouble. Understanding the process, the actual rules of engagement, is absolutely key to seeing where the opportunities are. You know, companies get into trouble for two main reasons. On the left, you've got the dream scenario for a distressed investor, a fundamentally good company that just has a terrible balance sheet. Maybe they took on way too much debt. The business itself is solid, you just need to fix the finances. On the right, though, that's the nightmare. It's a company with a failing business. It doesn't matter how little debt they have if nobody wants their product. As an investor, you run away from that one. Now, if the company can't fix things on its own and has to file for bankruptcy, it usually goes down one of two roads. Chapter 11 is a reorganization. Think of it as hitting the pause button. The company keeps operating, but the court gives them protection from their creditors so they can work out a plan to get healthy again. This is for businesses that are still worth saving. Chapter 7, that's liquidation. It's the end of the line. The business is just not viable. They shut the doors, sell everything off, and whatever cash they can raise gets handed out. It's basically the corporate death penalty. So, in a bankruptcy, who gets the money? There's a strict hierarchy, a pecking order. Right at the top, you've got the lawyers and the accountants running the bankruptcy. They always get paid first. Then come the senior bondholders, then the junior bondholders. Way, way down at the bottom of the list are the common stockholders. They usually get wiped out completely. But here's where it gets messy. That pecking order isn't always so clean. A junior bondholder might sue and tie the whole process up in court, hoping to pressure the senior guys into giving them a bigger piece of the pie just to make the problem go away. Okay, so let's talk about how one of the greatest investors of all time, Warren Buffett, has played in this sandbox. Looking at his wins and, his losses can teach us a ton. Buffett's play on RGR and Nabisco is the perfect example of that good company, bad balance sheet idea we just talked about. This was a company that made things like Oreo cookies and Ritz crackers, a fantastic business, but it had been loaded up with an insane amount of debt from a buyout. When a recession hit in 1990, the market panicked and the bonds tanked. Buffett saw the fear, but he also saw the value. He stepped in and started buying up those bonds for about 60 cents on the dollar. And check out the result. In just a few months, RJR Nabisco did exactly what a smart company would do. It sold off some non-essential parts of the business, raised some cash, and paid off the bondholders. Buffett's Berkshire Hathaway made a cool 75% gain. It was a masterclass in being greedy when others are fearful. But even the Oracle of Omaha gets it wrong sometimes. Buffett will be the first to tell you that his investment in US Air was a huge mistake. He got suckered in by a fancy feature on the preferred stock he bought, and he ignored the brutal reality. The airline industry is a terrible business. His own mentor, Ben Graham, had warned about this exact trap. It was a very expensive lesson that no matter how clever a security is, you're ultimately a hostage to the underlying business. And that US Air mistake leads us perfectly to what is, without a doubt, the single most important tool for looking at a distressed company. And I'll give you a hint, it's not the income statement that everybody obsesses over. This right here is the mantra for any distressed investor. Profit is an opinion, cash flow is a fact. Think about it. There are all sorts of accounting games you can play to make your profits look good. But cash? Cash is real. It either came into your bank account or it went out. You can't fake it. If you want to know the truth about a company's health, you follow the cash. And the way you do that is by breaking down the statement of cash flows into 3 parts. First, cash from operations. This is the big one. Is the actual day-to-day business generating cash or is it losing it? Second, working capital. Is cash getting tied up building inventory that isn't selling? And third, investing in financing. Is the company surviving by selling off its buildings and equipment or by taking on more and more debt just to keep the lights on? A healthy company lives on the cash from its operations. A sick one lives on borrowing and selling assets. Now let's put this into practice with a famous disaster, WorldCom. This summary tells a chilling story if you know how to read it. Look at the cash from investing. They were burning through billions more, year after year, than they were bringing in from their actual operations. So, where did all that money come from? Just look down at the financing section. They were borrowing billions upon billions just to fund their out-of-control spending. This wasn't a business that was growing. This was a business that was hemorrhaging cash, and the only thing keeping it alive was more debt. The warning signs were right here in black and white. And that WorldCom example brings us straight to the absolute necessity of spotting red flags. It's not just about the numbers. Sometimes it's about the people running the show. Now, here is a fascinating tip that you won't find in most textbooks. Take a look at the personal finances of the CEO. Right before WorldCom imploded, its CEO, Bernie Ebbers, was personally leveraged up to his eyeballs. He had borrowed a fortune to buy company stock, and he was on the verge of going bankrupt himself. A person who manages their own money that recklessly is probably doing the same thing with the company's money. It's an incredible pattern. We saw the exact same thing at Enron and Conseco. Here's another example of how the official accounting can hide a terrifying reality. At first glance, WorldCom's balance sheet looked okay. Almost $58 billion in equity versus about $24 billion in debt. Looks fine, right? But look closer. Almost $46 billion of that equity was an intangible asset called goodwill. That's basically just a plug number from paying too much for acquisitions. Once you strip that out, the company's real tangible net worth was less than $12 billion, holding up more than double that in debt. The company was completely insolvent, and it was right there for anyone to see. Okay, for our last section, let's zoom out. Because it's not just companies that can go broke. Sometimes entire countries default on their debt. And when that happens, the shockwaves can shake the entire global financial system. Now, when you're looking at a country's debt, there is one question that is more important than any other. What currency is the debt in? If a country borrows in its own currency, say Japan borrowing in yen, it can technically never default. Why? Because it can always just print more yen to pay the bills. Now, that might cause massive inflation, but it's not a default. But if a country borrows in a currency it can't print, like US dollars, then default is a very, very real danger. Back in the 80s, there was a huge crisis with countries in Latin America defaulting. The solution they came up with was brilliant. It was called the Brady Bond. Here's how it worked. A country in default would take some of its money and buy super safe US Treasury bonds. These bonds would be used to 100% guarantee the principal on its new restructured debt. The banks would then swap their old worthless loans for these new Brady bonds. Sure, they got a lower interest rate, but now the principal was backed by the full faith and credit of the United States. It was an ingenious solution that helped pull the world back from the brink. So that leaves us with one final question. After all this, what is distressed investing, really? Is it a calculated science of poring over financial statements and legal documents, or is it more of a dangerous art, requiring you to judge people's character and predict how they'll act under incredible pressure? The truth is, it's both. And that's what makes it one of the most difficult, and for those who get it right, one of the most rewarding games in the entire world of finance. All right, welcome to The Explainer. Today, we are going to pull back the curtain on something that's absolutely critical to understanding any business, but it's almost always misunderstood. We're talking about the huge gap between the profit a company says it makes and the actual real cash it has in the bank. We're going to learn how to follow the money because, let me tell you, the cash tells a completely different and, frankly, a way more honest story about how healthy a company really is. So let's just start with this kind of a bombshell idea from our source material. You know that big net income number, the profit you see in all the headlines? You should think of it less like a hard fact and more like an opinion. Yeah, an opinion. It's a number that can be massaged, it can be managed, and it can be shaped by all sorts of different accounting choices. It is absolutely not the bedrock truth that we're all led to believe it is. Okay. So if we can't really trust that bottom line earnings number, what can we trust? I mean, if the number that everyone focuses on is so flexible, where's the solid ground? Well, to get to the truth, we have to just, for a moment, ignore all the accounting interpretations and learn to do one simple thing: follow the cash. Okay, let's really dive into this. We're going to strip a business down to its bare essentials. Think of it like this. We're walking right past the shiny paint job and the fancy hood ornament on a car. We're going straight into the engine room to see how much raw power, how much real cash that engine is actually producing from its day-to-day operations. So our starting point is this number called EBIT. The easiest way to think about this is it's the purest measure of cash that a business generates. It's just the money that came in from selling stuff, minus the cash it cost to make that stuff, and minus the cash it took to run the company. Things like salaries and rent. That's it. No accounting tricks, no financing costs, just pure unadulterated cash from the actual business. Now, from that raw, pure EBITDA number, we only subtract two more things. And these are things the company actually had to pay for in cold, hard cash during the year. We take out the interest payments it made on any debt, and we take out the actual tax bill it paid to the government. And what we're left with? That's the available cash flow. This is the real pile of cash the company has to play with, to invest, to save, or to give back to its owners. And here is where it all clicks. This is how we connect everything back to that opinion of net income. It turns out you can get to that exact same available cash flow number by just starting with the reported net income and adding back two major non-cash expenses. And the biggest, the most important one of these by far is depreciation. This little formula you see right here, that is a key that unlocks this entire puzzle. And now for the big reveal. Let's really get into depreciation because this is the source of one of the biggest illusions in all of finance. We're about to see exactly how a simple accounting choice can make a company look less profitable on paper, while in reality, it's actually getting significantly richer. This, my friends, is where accounting meets pure strategy. So any company with physical stuff, buildings, machines, computers, they have to account for the fact that this stuff wears out. Now, they can use a straight line method, which is slow and steady. It spreads the cost out evenly, and this makes the reported profits look really nice and high. Or they can use an accelerated method, which takes a much bigger financial hit right up front. Now, this crushes reported earnings in the early years, but it has a hidden superpower. Okay, look at this. This is fascinating. Just focus your eyes on the bottom two rows. Both companies start with the exact same cash flow, $250,000. The company on the right reports a tiny net income of $33,000. That's a third of the other company. But look at its after-tax cash flow. It's $233,000. That's way higher than the $199,000 generated by the supposedly more profitable company. How on earth is that possible? Here's the magic trick. By reporting $66,000 less in profit, the company on the right was able to double its non-cash depreciation expense. That bigger expense acted like this massive shield for its cash, protecting it from the tax man. And the direct result? A tax bill that was $34,000 smaller. The company put an extra $34,000 of real, actual cash into its bank account, simply by choosing an accounting method that made it look less profitable. And this just completely blows up that old myth you sometimes hear that depreciation is a source of funds. It's not. The business generated the cash from its actual sales. Depreciation is just an accounting rule, a perfectly legal tax shield that lets a company keep more of the cash it's already made by basically telling the government, hey, this portion of our cash, you can't count that as taxable profit. So now that we know how to find the real available cash, we can take our analysis up to the next level. Let's build on this and try to understand what it means for a business to truly create economic value for its owners. And believe me, that is a very, very different question than just asking, hey, did you guys report a profit this quarter? This brings us to what a lot of investors consider the holy grail, free cash flow. And we get here by asking one more kind of brutally honest question. Of all that cash the company generated, how much of it did it have to turn around and plow right back into the business just to keep the lights on? How much did it spend replacing worn-out machines and updating its tech just so it wouldn't fall behind? The cash that's left after all that, well, that's what's truly free and available to the people who own the company. And this table just brilliantly lays out the ultimate difference. See, accounting earnings subtracts depreciation, which, as we've just seen, is really just an accounting estimate. It's a guess. But true economic earnings, the real measure of value creation, that subtracts the actual cash the company spent to maintain and replace its assets. This is called replacement capital expenditures, or CAPEX, and that represents real money going out the door. And right here, this is the insight that separates the great businesses from all the rest. In a lot of really capital-intensive industries, think about airlines with their planes or car makers with their factories, the real cash they need to spend just to stay competitive is often way bigger than the depreciation number on their books. So yeah, they might report an accounting profit, but in reality, they're on a treadmill spending every single dollar of cash they generate just to keep from falling backwards. That's not value creation, that's just survival.
It really all boils down to this elegantly simple test from Warren Buffett. He argues that the single most important job of any manager is deciding where to put the company's capital. When they spend a dollar of the owner's cash, doesn't matter if it's on a brand new factory or just replacing an old truck, does that investment create at least a dollar of genuine, long-term value for the company? Because if the answer is no, they are actively destroying wealth, no matter what the glossy earnings report might say.
And trust me, this is not just some abstract theory for investors to debate. Understanding this gap between accounting profit and real cash flow, that is the central battlefield in high-stakes corporate warfare, from hostile takeovers to activist investor campaigns. This is where fortunes are literally won and lost. In the world of leveraged buyouts, or LBOs, cash flow analysis is basically a weapon. These firms hunt for companies with predictable, steady cash flows that are kind of hidden by the accounting rules. Then they borrow incredible sums of money against those cash flows, and they use the interest on that new debt and the company's depreciation as these giant tax shields. They are, in essence, using the company's own cash-generating engine to buy it. But as the source material points out, it is a very dangerous game. If they cut back on capital spending too much in order to pay off the debt, they can literally starve the business to death. This very same logic is what gave rise to the activist investor. Back in the 70s and 80s, this guy T. Boone Pickens saw that oil companies were just swimming in cash but were wasting it on terrible acquisitions. He realized their stock prices were completely disconnected from their underlying cash value. So, he launched these huge takeover battles to force them to give that cash back to its rightful owners, the shareholders. And you saw the same exact battle of wills play out decades later at Chrysler, a massive fight between a management team that wanted to hoard cash and an activist investor who demanded they pay it out. This constant fight over what to do with a company's cash, save it, reinvest it, or pay it out, it often forces a company to look at its fundamental financing. And it leads us to a final, really critical question. What is the right balance between debt and equity for a company to have in the first place? For decades, there was this famous academic theory that said, in a perfect world, it didn't really matter how a company was financed. Its total value would be the same. Well, we don't live in a perfect world. And a spectacular real-world blow-up in the late 90s delivered a very harsh and a very, very expensive lesson on the subject. The near implosion of the hedge fund long-term capital management was the ultimate reality check. This was a firm run by literal geniuses. We're talking Nobel Prize winners who helped write the theories in the first place. They believed leverage was just a mathematical tool, and they borrowed about $30 for every single dollar of their own capital. Well, when the market moved against them just a tiny bit, that leverage acted like a tidal wave, magnifying their losses to the point where it literally threatened to take down the entire global financial system. It was the definitive, terrifying proof that, yes, your capital structure matters immensely. So, what's a safe level of debt? Well, it definitely varies by industry, but our source material suggests a pretty conservative rule of thumb to avoid getting into trouble. Debt should ideally make up less than 30% of a company's total capital. You stay below that threshold, and a company generally has enough of a cushion to weather the unexpected storms without facing those catastrophic risks that come with too much debt. And so we'll leave you with this thought. Now that you understand the crucial difference between accounting fiction and economic reality, you're equipped to see right through the headlines. The next time you see a company proudly announce its record earnings, you'll have the insight to just pause, nod, and ask the much smarter, much more important question. That's interesting, but show me the cash. All right, welcome to The Explainer. Today, we're really going to get back to basics, breaking down some of the most timeless principles of valuing a business, what we call asset-based valuation. This is a real cornerstone of investing wisdom, the kind of stuff that helps you separate disciplined, smart analysis from what's really just guesswork. It's all about finding an anchor in the often turbulent sea of the market. Okay, let's dive into this. So this is the big one, right? This is the fundamental question that every single person in the market has to ask themselves. And honestly, the answer is what separates long-term, repeatable success from pure short-term speculation. Are you building your wealth on a solid foundation, or are you just rolling the dice and kind of hoping for a lucky number? And the whole core of what we're talking about today is this very distinction. You see, true investment in the classic sense is grounded in analyzing things you can actually know, the real, tangible assets a company owns, the actual cash it's generating right now. Speculation, on the other hand, well, it relies almost entirely on trying to forecast a future that is, by its very nature, uncertain. It's all about trying to guess what earnings might be years and years down the road. And here's a key reason why trying to guess like that is just so incredibly difficult. There's this economic concept called the marginal efficiency of capital. Now, it sounds a little academic, but the idea is actually dead simple. A company's first investments, they're usually in its most profitable projects. But as it gets bigger, it has to find new places to put its money. And each new dollar it invests tends to generate a slightly lower return than the one before it. As they say, trees just don't grow to the sky. And this chart just lays it out perfectly. I mean, think about it. The first dollars a company invests, boom, fantastic returns. The next batch of money? Yeah, pretty good, but not quite as great. And the last dollars it invests? Well, they might only earn a return you could get from a simple bank CD. This constant downward pressure makes that explosive, sustained growth that speculators are always betting on, well, it makes it nearly impossible over the long run. So here's how we're going to build our understanding today. We're going to start with the very foundation of value. Then we'll look at the serious risks of debt. We'll uncover what's hiding off the books. Then we'll apply these ideas to modern companies. And finally, we'll tie it all together with probably the most important concept of all, the margin of safety. Okay, so let's start with that foundation. What we're really looking for here is an anchor. Something solid, something dependable that we can hold on to in the chaotic storm of market speculation and those constantly shifting earnings forecasts. The classic Graham and Dodd approach starts right here, with this idea of book value. Now, the easiest way to think of it is as the company's net worth on paper. It's a really straightforward calculation. You just take everything the company owns, all its assets, and you subtract everything it owes. What's left over is a conservative, knowable estimate of its worth, completely stripped of any intangible hype or speculative bets on the future. Now, it's considered conservative for a very, very good reason. Look at what it typically doesn't account for. I mean, these are incredibly powerful but very hard to quantify assets. The global recognition of the Coca-Cola brand, for example, has immense value, but you're not going to find it listed as an asset on their balance sheet. And this exclusion is actually part of its strength as a baseline. It gives you a hard, tangible floor of value to work up from. Okay, so we've got this solid foundation of book value, right? Well, what's so fascinating is how that solid foundation can be completely destabilized by one single powerful factor: debt. I'm telling you, leverage is the ultimate double-edged sword in finance. And I don't think anyone has ever captured the danger more perfectly than Warren Buffett with this analogy. He said it makes for a very alert driver or a very alert management team because the stakes are just so incredibly high. But one small pothole on the road, one unexpected business downturn, and it can be absolutely fatal. This simple mortgage example shows you exactly how this works in the real world. Let's say you buy a $100,000 house with $20,000 of your own money. Now, imagine the house's value then drops by 30%. That's a big dip for sure, but it's not a total collapse. The problem is that $30,000 loss comes directly out of your $20,000 stake. Your equity is completely wiped out, and you still owe the bank $80,000. The exact same scary principle applies to companies that are loaded up with debt. But on the flip side of all that danger is this unique kind of opportunity, what Benjamin Graham called his ultimate safety net. He would actually look for companies that were trading for less than the value of their cash and their easy-to-sell inventory after you paid off all of their debts. In these net-net situations, you're basically buying $1 of liquid assets for, say, 70 cents. And you got the entire ongoing business, the factories, the brand, all of it, thrown in for free. But, as we've already hinted, that official book value on the page isn't always the full story, not even close. A really thorough investor needs to look below the surface, searching for assets and liabilities that don't always make it onto the main financial statements. I think the best way to think of a company's true value is like an iceberg. The reported book value is just the tip that you can see poking out above the water. The real story, the massive bulk that can either sink you or represent this huge hidden prize, is often submerged, totally hidden from plain sight. And this isn't just some abstract theory. Look at this, a real-world example with Exxon way back in the early 80s. Its stated book value was about $35 per share, but thanks to an SEC rule, they also had to disclose the estimated value of their oil reserves, which weren't on the main balance sheet. When you added those in, the true asset value was closer to $52 a share. Now, with the stock trading in the high 20s, it went from looking like a pretty nice discount to an absolutely massive one. Of course, this cuts both ways. Liabilities can be hidden too. A company might have huge long-term lease payments that function just like debt but aren't listed that way. Or it might have massive unfunded promises to its retirees. I mean, back in the 1990s, U.S. auto companies were finally forced to account for these retirement benefits. Seemingly overnight, stocks that looked like they were trading at a discount to book value were suddenly trading at premiums because their true book value had just plummeted. Okay, so I know what you might be thinking. This all makes sense for old-school industrial companies, but how on earth can we apply this seemingly old-fashioned idea of book value to today's fast-moving tech stocks, or to those really volatile cyclical industries like steel or chemicals? Well, for modern, high-quality companies, we can use a metric called return on equity, or ROE. And simply put, it just measures how efficiently a company uses the shareholders' money to generate profits. The source material we're drawing from here suggests this modified formula. Now, it sets a really high hurdle, an ROE of 15%, before you should even consider paying more than book value. But if a company consistently clears that bar, the formula allows you to pay a justifiable premium. The crucial point is, it sets a very, very high bar for quality. Just look at this table. To feel comfortable paying just twice what a company's worth on paper, it needs to be generating a return on equity of over 21%. To pay 4 times book value, it needs an ROE of 30%. You see, this imposes a really strict discipline, and it makes sure you only pay up for truly exceptional, proven performance, not just the promise of it. And for those cyclical stocks, the ones that have those huge booms and busts, the approach is different. The really big mistake people make is to look at them at the peak of their cycle, see massive earnings and a huge ROE, and then assume that feast is going to last forever. The real solution is to ignore the noise of any single year and instead use a long-term average ROE, say over 10 or 15 years, to get a normalized sense of the company's true underlying earnings power. Okay, let's bring all of this together now. What is the ultimate goal of all this digging around in balance sheets and adjusting for hidden assets and calculating normalized returns? It all comes down to one thing. The entire purpose of all this work is to build what Benjamin Graham famously called a margin of safety. By grounding your purchase price in solid, knowable asset value, and ideally buying at a significant discount to that value, you protect your principal from the wild swings of market sentiment and, frankly, from your own potential mistakes. It gives you incredible downside protection while keeping all of the upside potential. So, to recap, what are the crucial takeaways here? First, remember that real investment is based on what you can know, not what you have to guess. Second, use book value as your conservative anchor in the market. But, and this is a big but, always be terrified of how leverage can magnify your risk. Third, dig deeper than the balance sheet to find those hidden assets and liabilities. And finally, know that these timeless principles can absolutely be adapted to value almost any kind of business, from high-tech to heavy industry. And that, really, is the question this entire approach empowers you to answer. It helps you tune out all the noise and all the hype about tomorrow, and instead focus on finding tangible, durable value that exists right here, today. Thanks for joining us for this edition of The Explainer.
You know, when we talk about investing, our minds usually jump to the exciting stuff, right? The explosive growth stocks, the disruptive tech companies that are going to change the world. But what if I told you one of the most powerful, most honest signals in the entire market is something a lot simpler, something we tend to overlook? I'm talking about the humble dividend. In this explainer, we're going to pull back the curtain and see why these simple cash payments are so much more than just a little extra income.
So let's just kick things off with a number that might actually blow your mind. When you look at where stock market returns have historically come from, over the long haul, you see this. That big slice right there, that's dividends. It accounts for about 45% of the total return. Think about that for a second. Nearly half of all the value stocks have ever generated didn't come from soaring prices. It came from cold, hard cash paid directly to shareholders. That one fact alone should completely change how we think about investing. And that, of course, leads to the big question, doesn't it? If dividends are this huge a piece of the pie, why do we barely ever talk about them? Why is all the financial news obsessed with the daily roller coaster of stock prices and flashy earnings reports? It's a real mystery. And that's exactly what we're going to unravel today. We're going to learn to speak the hidden language of dividends and figure out what they are really telling us.
Here's our game plan. We'll start by making the case for dividends as the unsung hero of returns. Then, we'll learn to speak their language. After that, we'll build a kind of field guide so you can spot different types of dividend payers in the wild. We'll study the strategies of the masters, and we're going to wrap it all up with a simple but incredibly powerful formula for finding a stock's true worth. By the end of this, you're going to have a whole new lens for looking at the market.
Okay, let's dive in. Section 1, the unsung hero of returns. This is all about getting back to a fundamental truth of investing. At the end of the day, it's about getting cash back from a business you own a piece of. And, well, there is no more direct or honest way for a company to give you that cash than a dividend.
Which leads us perfectly into Section 2, the language of dividends. The big idea here is to stop seeing a dividend as just a payment. Instead, think of it as a direct message, a communication from a company's management straight to you, the owner.
You know, this quote from the legendary investor Geraldine Weiss it nails it. Dividends are paid in cash. You can't fake cash. Companies can play all sorts of games with their earnings reports, using accounting tricks to make things look better than they are. But a dividend, that's real money leaving the company's bank account and landing in yours. It is the ultimate proof that the profits are real.
So what's it telling you? Think of a dividend as a company's truth serum. First, it proves the earnings are real. It shows that management is confident enough about the future to part with actual cash. It's a tangible promise, a real commitment to you as a shareholder. And the flip side of that is just as important. A dividend cut. That's one of the biggest red flags in all of investing. It's a blaring siren that signals deep, deep trouble.
Okay, so to understand this language, we need a key tool. In the US, we call it the payout ratio. And it's super simple but incredibly powerful. It just asks, what percentage of the company's profits are they paying out to shareholders? This one little number tells you a ton about a company's financial health and its entire philosophy on rewarding its owners.
And just a quick note, if you ever look at British companies, they measure the same thing, but they flip it upside down and call it the coverage ratio. So a 50% payout ratio here is the same as a 2x coverage ratio there. Don't let it confuse you. They're both just asking the same basic question. How safe is this dividend? How much breathing room does the company have? So what's a good payout ratio? Well, it all depends on the company's story. A young, hungry growth company is going to have a low payout ratio, probably under 40%, because it needs to reinvest every spare dollar into growing the business. A more average, stable industrial company might be in that 40 to 50% sweet spot. But a very mature business like a big utility will have a high payout ratio, maybe over 60%. Why? Because its main job isn't rapid growth anymore. Its job is to be a cash machine for its owners.
And that brings us right into Section 3, a field guide to payers. Because, just like out in nature, there's a whole ecosystem of different dividend-paying companies. And if you're going to invest in them, you need to know how to tell them apart.
We can break them down into roughly 3 big categories. First, you've got your steady eddies. These are your low-growth utilities. They act a lot like bonds. They're stable, and they usually offer the highest yields. Second, you have the cyclicals, your big industrial companies in things like oil or steel. Their fortunes go up and down with the economy, but they can be fantastic protection against inflation. And third, you have the future giants. These are fast-growing companies that start out with a tiny yield, but whose dividends could absolutely explode higher in the years to come.
But here's the thing. No matter what type of company we're talking about, the number one danger is always the same. The dividend cut. It is the cardinal sin in the dividend world. And what causes it? Well, it almost always boils down to one of two things. Either the company got greedy and took on way too much debt, or it's in a cyclical business and the bottom just fell out of its market.
So how do you spot the trouble before it happens? You got to look for the warning signs. An erratic payment history. That's a bad sign. If they've cut it before, they might do it again. Piles of corporate debt. That's a huge red flag. But this next one, this is absolutely critical. Check if the company is easily covering the interest payments on its debt. You have to remember, the people who loan the company money, the bondholders, they have a legal right to get paid. You, the shareholder, you only have a moral one. If they're struggling to pay the lawyers, you can be sure you're not getting paid.
Okay, so that's the theory. We've got the language down, we can identify the players. Now, for Section 4, let's look at how the pros actually put this stuff into practice. This is where the rubber really meets the road. Strategies of the dividend masters.
Let's start with Geraldine Weiss again. She had this absolutely brilliant insight. She realized that for any stable company, its own dividend yield history creates a kind of natural value band. When the yield is way higher than its historical average, it means the stock price is low. The stock is cheap, it's on sale. And when the yield is historically low, the price is high, and it might be time to sell.
As she put it, the trick is to buy near the bottom of the band and sell near the top. It's so beautifully simple.
And let's look at a classic example here with Philip Morris back in the 90s. In 1992, the stock was flying high, which pushed its dividend yield way down to a historically low 2.7%. That was Weiss's signal to sell. But then, look what happens. Just a year later, the stock price had gotten hammered, which sent the yield soaring to 5.8%. That's a screaming buy signal. By following the yield, you'd be systematically buying low and selling high, using the stock's own history as your guide.
Another really famous method is called the dogs of the Dow. This one is pure mechanical, rules-based investing. It's so simple. At the start of every year, you take the 30 big blue-chip stocks in the Dow Jones Industrial Average. You just rank them by dividend yield, high to low, and then you buy an equal amount of the 10 stocks with the highest yields. You hold them for 1 year, and then you do the whole thing over again. The logic here is that these are all massive, stable companies that have just temporarily fallen out of favor with the market, which makes their prices low and their yields high.
All right, it's time for our final section, and this is where we're going to tie everything together with one elegant, powerful tool, the investment value formula. This is about getting a single number that helps us measure what a company is really worth, away from all the market noise.
Now, this formula comes straight from the founding fathers of value investing, Benjamin Graham and David Dodd, and the genius of it is its simplicity. It completely ignores the day-to-day whims of the market and focuses on just two real, concrete things. First, what a company owns, its actual assets, and second, what it pays out to you, its dividend stream.
And here it is. Investment value equals book value plus 10 times the annual dividend. Let's just quickly break that down. Book value is basically what would be left over if a company sold off all its stuff, its factories, its inventory, everything, and paid off all its debts. And 10 times the dividend is a way of valuing the cash stream itself. It assumes a 10% return on that stream is a fair price to pay. So you're adding together the value of the company's stuff and the value of the cash it sends you. That's it.
So, the big question, right? Does this thing actually work? Well, let's look at one of Warren Buffett's most famous investments. Back in 1981, he was buying shares of General Foods. The book value was about $31 per share. The dividend was $2.20. You plug that into our formula, 30.86 plus 10 times 2.20, and you get an investment value of $52.86. And what was the stock trading for in the market? Somewhere between 27 and 32 bucks. He was buying a dollar's worth of real value for about 55 cents. It was an unbelievable bargain, and this simple logic is what helped him spot it.
And that really brings us to our conclusion, your new investing lens. We've taken this whole journey together from seeing dividends as just a small income stream to understanding them as a language, a way to classify companies, a foundation for real-world strategies, and finally, a core piece of a company's true value. It's really about shifting your entire perspective on what matters.
So I'll just leave you with this one question to think about. The next time you sit down to analyze a stock, what are you going to look for? Are you going to get caught up in a good story, or are you going to look for a good dividend? Your answer to that question might just change the way you invest forever.
All right, let's talk. Today, we're going to peel back the layers on the one number in finance that gets all the attention. It moves markets, it makes headlines, it can literally make or break fortunes overnight. I'm talking, of course, about earnings. But as you're about to see, that number, well, it isn't always telling you the whole truth. You know, it's funny. In the world of investing, there's been this huge shift. If you go back a few decades, guys like Benjamin Graham, the legends, they were all about the balance sheet, what a company actually owned, hard assets. But today, the game's completely changed. Everybody from Wall Street pros to the person trading on their phone is fixated on the income statement, specifically on guesses about future earnings per share. And that leads us right to the big, kind of uncomfortable question we're tackling here. What if that number, the one you're basing huge decisions on, isn't really designed to inform you, but to persuade you? What if it's just telling you a story that sounds good, but isn't quite real? Okay, let's really dig into this. So here's our game plan. First, we'll look at why we're all so obsessed with earnings to begin with. Then we're going to get into the weeds of how profits are really calculated and where all the traps are hidden. We'll take apart earnings growth, learn how to separate the real signal from all the market noise, check out how the masters think about valuing real, sustainable growth, and then we'll wrap it all up with a checklist you can actually use. So, like I was saying, we've gone from an asset-based world to an earnings-based one. And the logic, on the surface, makes sense. Earnings are what create assets and pay dividends down the road. But this puts an enormous amount of weight on something that is, at its core, an estimate, a guess about what's going to happen, instead of the concrete value of what a company has in its hands right now. And that shift, believe me, changes everything for an investor. Now check this out. This is a perfect illustration of the problem. This is old data from Cadbury Schweppes. Take a look at that top line, net profit. It's growing from 265 million to 360 million. Seems pretty good, right? But then look at the bottom line, earnings per ADR. That's basically earnings per share for you, the owner. It went nowhere. It actually dropped a little. So what happened? The middle line tells the whole story. The number of shares just exploded. The company was making more money, sure, but they were slicing the pie into so many more pieces that each individual slice actually got smaller. That's the key takeaway here. Rising profits for the company don't mean a thing if your share of those profits is shrinking. And that brings us to the next problem. Because even if a company isn't diluting your stake, that profit number itself can be, well, let's just say it can be pretty murky. See, there's a rule book for how you report earnings, but that rule book leaves a lot of room for interpretation and, yeah, for manipulation. First, you've got the official number. That's GAAP earnings. It stands for Generally Accepted Accounting Principles. Just think of it as the standard rulebook that every public company is supposed to follow. It's not perfect, but at least it's a common measuring stick for everybody. But then you have this other thing that became really popular, pro forma earnings. This is the story that management wants you to hear. They basically create their own adjusted number, and they do it by throwing out certain expenses they say are one-time things, all to paint what they think is a more accurate and almost always a better-looking picture of the business. And this just lays it all out, side by side. GAAP is standardized. Pro forma is whatever management wants it to be. GAAP includes all the required costs, the good and the bad. Pro forma often conveniently leaves out things like restructuring charges or the cost of giving executives millions in stock options. So while GAAP might be a little rigid, pro forma earnings can become a tool for managers to just pump up their stock. It's like they're saying, here's the official story, but here's the story we wish were true. And the toolkit for telling a better story is pretty big. Companies can just ignore the very real cost of stock options. During a good market, they might count paper gains on their pension plan as real operating income. And then you have my personal favorite, a move called kitchen sinking. Here's how it works. Say you're already having a bad year. Management just decides to throw in every single loss and write-off they can possibly find, the whole kitchen sink. It makes the bad year look absolutely terrible, but it sets an incredibly low bar for the next year, making future growth look amazing by comparison. So you see how this stuff builds. It's not just about the quality of the earnings number. It's also about how we measure the growth of that number. Wall Street loves to see growth that's accelerating, but that obsession can create some really dangerous optical illusions. A classic rookie mistake is comparing one quarter's results directly to the one that just ended. But most businesses have a natural rhythm, a seasonality. I mean, you'd never compare a toy store sales in December to its sales in February, right? So to get around that, we compare this year's quarter to the same quarter last year. But even that has a hidden trap. Let's look at a real example here from Zale, the jewelry retailer. The January quarter, which of course includes Christmas and the holidays, is always their strongest. You can see they made $1.75 per share. Then you have the April quarter, much weaker, only 17 cents. Now let's watch what happens when we look at the growth from 99 to 2000. And here's the punchline. In their strongest quarter, earnings grew by a really healthy 33%. Not bad at all. But in their weakest quarter, the year-over-year growth was a jaw-dropping 76%. Now, if you just saw that number, you'd think, wow, this company is on fire. Growth is accelerating like crazy. But it's just a math trick. When you start from a really, really low number, even a tiny absolute gain looks like a massive percentage jump. It's the seasonality trap in action. So, if the earnings numbers themselves can be fudged and the growth rates can be totally misleading, what about the experts, the analysts who get paid the big bucks to figure all this out? Well, relying on them comes with a whole other set of problems. It's all about trying to find the real signal in a whole lot of noise. There are three huge issues here. First is what we call false precision. An analyst builds this incredibly complex spreadsheet that spits out an earnings estimate down to the exact penny.
It creates this illusion of scientific accuracy for what is, at the end of the day, just a sophisticated guess. Second, the guesses are usually too optimistic. It's just human nature. And that's why you see so many more negative earnings surprises than positive ones. And finally, you've got this sneaky little problem of whisper numbers. This is the unofficial, real number that the big hedge funds and analysts are actually expecting. So a company can meet its official public target, but if it misses that secret whisper number, the stock still gets hammered, and Main Street investors are left wondering what on earth just happened.
So if we can't completely trust the reported earnings or the growth rates or even the analyst estimates, how in the world are we supposed to figure out what a business is worth? Okay, this is where we shift gears. We've taken apart the problems. Now let's look at some more durable ways to think, frameworks used by the investing legends. You've probably heard of a popular shortcut called the PEG ratio. The simple rule of thumb says you should buy a stock when its PE ratio is less than its growth rate. So a PEG of less than 1 is a buy. But this leads to some pretty crazy conclusions. I mean, think about it. Does a company growing at 1% a year really deserve a PE of only 1? No way. It's just a lazy tool that ignores the single most important question. How long can that growth actually last?
And this takes us right back to the founding fathers of this stuff. Graham and Dodd were deeply skeptical of paying high prices today for growth that might or might not show up years from now. They said, hey, anchor yourself to something real, something tangible, like the value of the company's assets and the actual cash dividends it pays into your hand. Later on, Graham came up with a formula to think about growth in a much more disciplined way. His model basically says the fair price-to-earnings ratio is 8.5 plus 2 times the growth rate. So a company with zero growth still gets a baseline PE of 8.5. From there, you add a little extra, but only for growth you believe is truly sustainable. It's just a much more grounded, conservative way to think about it than that simple PEG ratio. And then, of course, you have Warren Buffett, who took this to another level, but only for these incredibly special businesses he calls franchise stocks. For a rare company like Coca-Cola with a moat around its business that's almost impossible to cross, he uses a model like this. The key idea here is what's called autonomous growth. It's growth that happens almost on its own without needing to constantly reinvest tons and tons of new capital. For those companies, a high PE can be justified not because growth is insane, but because it's incredibly predictable and durable for decades. So how do you spot one of these rare gems? Well, here's a quick checklist of questions to ask. Has this company been dominating for a really long time? Is what they do unique and super hard for anyone else to copy? Can they raise their prices without losing all their customers? And finally, has the value of businesses, like this one, been proven in the real world and they get bought and sold? That's the kind of rigorous thinking you need before you go paying a big premium for growth. All right, let's pull all of this together. Let's make it practical. Before you get all excited about some company's latest earnings report or its amazing growth rate, just take a breath and run through a quick mental checklist based on everything we've talked about. And really, it all boils down to this one last and I think most important question you can ask yourself. Pro forma earnings, whisper numbers, misleading growth rates, they're all just tools for telling a really good story. But a great story doesn't always make for a great investment. Our job, our challenge, is to look past the pretty narrative they give us every quarter and to really understand the cold, hard reality of the business underneath. Because in the long run, it's the business, not the story, that's going to decide how you do. Thanks for your time. When you're looking at a company trying to figure out its real story, it feels a bit like being a detective, right? You're digging through all these reports, looking for clues. But what if the biggest clue of all was sitting right there in plain sight? Today, we're going straight to the top of the income statement, to the one number that kicks everything off. So let me ask you this, straight up. If you could only look at one single number to judge a company's future, what would it be? Just one. Think about it for a second. Now, I'm guessing your first instinct was to say profit. And look, that makes sense. Profit is hugely important. But here's the thing. Profit is the result. It's what's left at the end. The real story, the engine that makes the whole machine run, is the top line. It's sales. Because without that engine, nothing else matters. The whole company just sputters out. So why this laser focus on the top line? Let's really dig in and see why sales are more than just a number. They are the true compass for a company's health and the absolute bedrock of any real growth. This right here, this is the heart of the matter.
Any company can squeeze out a little more profit by cutting costs. They can lay some people off, find a cheaper supplier, and for a quarter or two, the numbers look great. But you can only cut so much fat before you're cutting into bone. There's a limit. Real, lasting growth, the kind we're all looking for as investors, can only come from one place: selling more stuff. It's the only road that doesn't lead to a dead end. And this basic fact has created a fascinating tug-of-war in the business world for decades. It's this constant battle between two completely different mindsets. Do we go all in on growing sales, or do we focus on protecting our profits by controlling cost? Just look at how dramatically things have shifted. If you go back to the 1960s, it was all about growth. The thinking was, hey, our costs are pretty much fixed, so let's pour money into advertising, build these amazing brands, and just drive sales through the roof. And it worked, especially when people had money to spend. But then, fast forward to the 1990s, and the whole philosophy flipped. It became all about cost control, about squeezing every last cent of profit from the sales they already had. It was like they were harvesting a field that was planted years ago without ever putting new seeds in the ground. You can see how that's just not going to work forever. Okay, so this leads us to a really crucial idea. Not all sales are created equal. You can have two companies, both with $1 billion in revenue, but the quality of that revenue can be worlds apart. So how do we, as investors, actually judge the quality of a company's sales? Well, here's a fantastic little checklist you can use. First, ask yourself, are they growing because they're selling more things, or are they just jacking up the prices? Growing volume is great, but being able to raise prices tells you they have a powerful brand. Second, what are the margins like? Is this a high-profit business, or are they selling tons of stuff but barely making a dime on each one? Third, who are they selling to? Is it a loyal fan base that comes back again and again, or are they constantly burning through cash to find new one-time customers? And last, do they even have room to grow? Can they sell more without having to build a whole new factory? Answering these questions paints a much, much clearer picture. And that first point about being able to raise prices, Warren Buffett absolutely nailed it with this metaphor. He loves businesses that have what he calls a toll bridge. It means they've got a product or service that's so essential and has so little competition that they can charge you a little more every year to cross, and you have no choice but to pay it. Now that is what high-quality sales looks like. All right, so we get the why. We understand the concept of high-quality sales. Now we need the how. We need the actual tools to measure this stuff, and that means we've got to talk about ratios. These are the tools every single analyst has in their toolkit. First up is asset turnover. Just think of this as the efficiency ratio. For every dollar of stuff the company owns, its factories, its inventory, all of it, how many dollars in sales does it manage to squeeze out? A company with a high asset turnover is just a lean, mean, sales-generating machine. Next up, net margin. This one's your profitability ratio. It's pretty simple. For every single dollar of sales that comes in the front door, how many pennies actually drop to the bottom line as pure profit? A high net margin tells you the company isn't just selling a lot, it's making real money doing it. And here's where the magic happens. This is where it all connects. When you take that asset turnover, your efficiency, and you multiply it by your net margin, your profitability, and then you factor in a company's debt, you get one of the most powerful numbers in all of finance, return on equity, or ROE. It's the ultimate report card on how well a company generates profits for its shareholders. And notice, that whole powerful chain starts with one thing: sales. Let's make this real with a classic example of just mind-blowing sales growth. Let's look at Walmart. Back in 1985, their sales were a tiny, tiny fraction of the entire US economy, just 0.21%, barely a blip on the radar. Now just watch what happens next. This chart really tells the whole story, doesn't it? By 2001, Walmart wasn't just a store anymore. Its sales accounted for over 2% of the entire GDP of the United States. That's the power of relentless compounding sales growth. They went from being a nobody to a force of nature that could literally move the needle on the whole national economy. And in investing, there is always a but, right? When the pressure to show sales growth is that intense, the temptation to cheat gets pretty strong. It's time to put our detective hats back on because we need to learn how to spot the fakes. One of the oldest tricks in the book is something called channel stuffing. It works like this. The company doesn't sell directly to you. It sells to big distributors or retail stores. Now, to make their quarterly sales numbers look amazing, they'll force feed more product into that channel than those stores can possibly sell to actual customers.
It's a shell game. The sales number looks fantastic for that one quarter, but all they've really done is steal sales from the future. So let me give you a little pop quiz, a real-world brain teaser. You're analyzing a company that makes barbecue grills, and you see their sales report, and there's this massive, record-breaking sales spike in the fourth quarter, October, November, December. What on earth is going on there? The only possible answer is they are not selling to people planning a Christmas barbecue. They are stuffing the channel. They're shoving those grills into Home Depot and Lowe's warehouses so the executives can hit their annual sales bonus. And for you, the investor, it's a giant, flashing red light. You know that a massive sales slump or huge inventory write-down is right around the corner. And believe me, it can get so much worse than just pushing a few extra grills. In some of the biggest scandals, like Enron, you had companies inventing sales out of thin air, using wildly optimistic guesses about the future to create fake assets today. And you gotta love Buffett, he had the perfect name for it. Not mark-to-market accounting, he called it mark-to-myth. Okay, so we know why sales are critical, we know how to judge their quality, and we know how to spot the shenanigans. So what's the last piece of the puzzle? It's figuring out how much we should actually pay for a company's sales. For this, our go-to tool is the price-to-sales ratio. It's super simple. Just take the company's total stock market value and divide it by its yearly sales. Now, this ratio is a lifesaver when you're looking at a company that doesn't really have profits yet, like a hot new startup or a company trying to turn itself around. In those cases, earnings don't tell you much, but sales can tell you everything. And the investing great Ken Fisher gave us some brilliant rules of thumb for this. The logic is just common sense. The more profitable the sales are, the more you should be willing to pay for them. So for a really excellent company with fat profit margins, paying 1.5 times sales might be a steal. But for a mediocre business, that same price would be way too high. The big warning, though, is to watch out for what he calls junk sales, revenue that looks good on top but adds almost nothing to the actual profit. And that all leads to this final, critical question you have to ask yourself every single time. When you're looking at that hot new company, that next big thing, are you buying simple addition or are you buying exponential multiplication? You know, at the very beginning, they look the same. 2 + 2 is 4 and 2 × 2 is 4. But the very next step is completely different, 6 versus 8. And a lot of investors get tricked into paying a multiplication price for a business that's only doing simple addition. At the end of the day, the test is always, always the quality and the sustainability of that top line. Hello and welcome. Look, most of us want a piece of the action in the stock market, but let's be honest, trying to pick individual stocks is a full-time job and it is packed with risk. The common answer you always hear is just buy a mutual fund. But are all funds created equal? And more importantly, how can we look at them with the same kind of tough analytical eye that legends like Benjamin Graham and David Dodd used for stocks? Well, today, that's exactly what we're going to do. We're diving into a much smarter way to look at mutual funds. So here's what we've got on tap. First, we'll lay out the big problem every single investor has to face. Then, we're going to decode mutual funds. We'll look at their history and some of the hidden dangers you might not know about. After that, we'll put on our Graham and Dodd glasses and apply their classic value investing lens to these funds. We'll even explore some really fascinating corporate hybrids. And then, we'll wrap up by talking about you, the strategic and psychological choices you have to make for your own portfolio. All right, let's jump in. Section 1, the investor's dilemma. You know, before you can find the right answer, you have to be absolutely crystal clear on the question you're trying to solve. And for most of us, it really just boils down to one big thing. This is it, right? This is the core of the problem. We all know that owning just one stock is a huge gamble. I mean, the company could soar, or it could crash and burn, completely separate from what the overall market is doing. But if you own a whole basket of stocks, you start to smooth out those wild swings. One stock zigs while another zags, and pretty soon your portfolio starts to act a little more predictably. The real challenge, though? Actually building that basket. Yeah, the textbook answer you always hear is diversification. It makes sense, right? 2 stocks are safer than 1, and 10 are safer than 2. But real, true diversification isn't just about owning, 10 different tech stocks. It's about spreading your money across different industries, different asset classes, maybe even different countries. And for most people, that level of work and analysis is just not realistic. And that's what leads them straight to the most popular solution out there. And that popular solution is, of course, the mutual fund. It's an attractive package, right? You get professional management all in one neat little bundle. But as we're about to find out, that convenience comes with its own baggage, its own complexities, and, well, a surprisingly rocky history. Okay, so let's quickly break down the two main types. Most of the funds you hear about are open-end. It's simple. You give the fund company your money, and they create brand new shares for you at the fund's net asset value, or NAV. That's just the total value of everything the fund owns, calculated once at the end of each day. Now, closed-end funds are a different beast. They have a fixed number of shares, and they trade on an exchange just like a regular stock. And here's the kicker. This means their market price can actually float above or below the real value of their assets. That can create some really unique opportunities and risks.
You know, mutual funds did not get off to a great start. They really got going right before the massive 1929 crash, and a lot of them were using this incredibly dangerous trick called double leverage. Basically, the fund itself was borrowing money to buy stocks on margin, and at the same time, investors were also borrowing money to buy shares of the fund. It was an absolute recipe for disaster, and losses were magnified like crazy. The SEC had to step in during the 30s to clean things up, but as some major scandals in the early 2000s showed us, the system is still far from perfect.
So let's talk about the first of these big scandals, late trading. Here's how it's supposed to work. All fund trades get priced at whatever the value is at the 4 p.m. market close. Period. But what was happening here was that some big, powerful clients were being allowed to place their orders after 4 p.m. So let's say a company releases fantastic earnings news at 4:30. These guys could illegally jump in, buy the fund, and get the 4 p.m. price, knowing for a fact that its value is about to pop the next day. It was just blatant cheating, pure and simple, and it came right out of the pockets of every other honest investor in that fund. And the second big scandal was market timing. Now, a lot of funds don't like it when people trade in and out really fast. It can mess up their long-term strategy. So they have rules or fees to discourage it. The scandal was that while they were slapping these penalties on regular folks like you and me, they were secretly letting their big favorite clients, and sometimes even their own managers, do it as much as they wanted with no penalty at all. It was the ultimate rules for thee, but not for me situation. So knowing that these funds can have some serious issues, how do we look past all the slick marketing brochures and find something that's actually built on a solid foundation? Well, this is where we bring in the big guns. We're going to apply the principles of Graham and Dodd to hunt for what they called deep value. A real Graham and Dodd style fund is a world away from your typical value fund. There are three big tells. First, it's probably going to have a high dividend yield. It values getting cold, hard cash in hand. Second, and this one might surprise you, it often has high turnover. Why? Because a deep value manager isn't buying a company to marry it. They're buying $1's worth of assets for 50 cents. And as soon as it gets back to being worth $1, they sell it, often in just a year or two. And third, and this is absolutely crucial, it focuses on asset value, or book value, what the company's stuff is actually worth. This creates a margin of safety that doesn't rely on wishful thinking about future earnings. Okay, now for a really fascinating and, you might say, unconventional idea. We're going to look at regular, everyday operating companies that, when you really get under the hood, act almost exactly like closed-end investment funds. Their main job isn't just selling a product. It's about being incredibly smart with where they put their money.
And the poster child for this, of course, is Warren Buffett's Berkshire Hathaway. I mean, on the surface, it's a holding company that owns insurance companies and railroads and candy makers. But when you look closer, a huge chunk of its value comes from its gigantic portfolio of stocks. The top guys like Buffett see their main job as being capital allocators, moving money to wherever it will generate the absolute best returns, whether that means buying a railroad or another few $1 billion worth of Coca-Cola stock. In everything but its name, it really is a closed-end fund.
And this table shows a brilliant way to actually think about a company like Berkshire. The author of our source material did his own back-of-the-envelope calculation, estimating that the investment portfolio alone was worth about 50 grand per share, and the actual operating businesses were worth maybe 10 grand. That gives you a total estimated intrinsic value of around $60,000 per share. So, as an investor, you can look at that number, compare it to the actual stock price, and decide for yourself if you think you're getting a bargain. This brings us to what might be the most important part of this whole discussion. See, it's not just about analyzing funds or companies. It's really about analyzing yourself. The strategic choice you make as an investor is deeply, deeply tied to your own personality and your own psychology. I know, this quote is a little dark, but it perfectly captures the herd mentality we see in investing. There's this strange comfort in just doing what everyone else is doing. If you all pile into the hot stocks of the day and it works out, great. And if it doesn't, Well, at least you're not suffering alone. Misery loves company, right? This powerful psychological force, this desire to just keep up with your friends and neighbors, can be a really dangerous thing. So this little matrix really lays out the stakes perfectly. You've got two basic strategies you can follow: aggressive growth or conservative value, and two possible futures: the market keeps booming or it all comes crashing down. Now, if you're aggressive and the boom continues, you could end up with great wealth. But if you're aggressive and a crash comes, you risk absolute poverty. Now look at the conservative strategy. In a boom, you get modest wealth. But here's the key. In a crash, you achieve relative wealth. While everyone else is getting wiped out, you're protected. The penalty for being wrong is so much smaller.
Fund manager Ralph Wenger came up with another brilliant analogy for this. Think of investors as a giant herd of zebras. The zebras on the very edge of the herd, they get the best, freshest grass. They eat really, really well. But when the lions come to attack, they are the first ones to get taken down. The zebras who stay packed in the middle of the herd might not eat quite as well, but they are much safer. So the question every investor has to ask themselves is, where in that herd do you feel comfortable standing?
All right, let's bring this home and talk about the practical side of managing all this. Investing is not a set it and forget it kind of deal. You have to know when to stick with what you've got, and maybe even more importantly, when it's finally time to sell. So here are 5 really solid reasons to think about selling a fund. First, if a star manager leaves, the genius you bet on is gone, so your thesis might be broken. Second, if the fund's whole philosophy changes, if that safe value fund you bought suddenly starts chasing risky tech stocks, it's not the fund you signed up for. Third, and this is an obvious one, if your personal needs change, maybe you're getting close to retirement, your portfolio needs to change too. And finally, you got to look at performance. If a fund just isn't hitting its own goals or it's constantly lagging behind its direct competitors, it might be time to find a better home for your money. Now, to be fair, we have to admit that funds are not a perfect solution for everybody. I mean, picking the right fund can be almost as tricky as picking the right stock. You get absolutely zero personalized service. The manager has no idea who you are or what your goals are. And because they're managing for thousands of different people, they might own things like junk bonds or volatile emerging market stocks that are completely wrong for you personally.
And this, from Buffett himself, might be the single wisest takeaway from all of this. There is absolutely nothing wrong with admitting you're not an expert stock picker. In fact, for many people, acknowledging that limitation is the smartest financial decision they will ever make. Choosing a simple, broad market index fund because you know that you don't know, well, that's not dumb money. That is self-aware, intelligent investing.
So we end with this question, and it's really a question for you to think about. We've gone through the tools, the history, the psychology, but the final and most important piece of this entire puzzle is you. What's your temperament? Are you an aggressive zebra on the edge of the herd, or a more conservative one in the middle? Figuring that out, understanding yourself, is the first and most critical step to building an investment strategy that you can actually stick with for the long haul. Thanks for joining me for this explainer.
Welcome to The Explainer. Today, we're going to sharpen our analytical tools and, well, pack our bags. Because we are embarking on a global expedition to find value, and we're using the timeless principles of Graham and Dodd as our compass.
Okay, let's just dive right in. And I gotta tell you, your investment map, it might be seriously out of date. Think about this. Right after World War II, the U.S. economy was an absolute juggernaut, making up about half of the world's entire economic output. Half! Fast forward to today, and that share is less than a third, and it's still shrinking as the rest of the world catches up. The whole economic center of the world, it's moved.
So here's our game plan for the journey. First, we'll make the case for why we should even bother looking overseas. Then, we'll talk about the risks and how to handle them. After that, we'll get our passport, which means understanding ADRs, before we take a whirlwind tour of value opportunities all over the planet. And finally, we'll bring it all home and figure out what it all means.
Let's start with the big question, right? The why. In a world with nearly 8 billion people, why should a careful value investor, someone who's focused on that margin of safety, even look beyond their own backyard? Well, the reasons are a lot more compelling than you might think.
Well, the first benefit is just simple math. You're fishing in a much bigger pond. A wider selection automatically boosts your odds of finding those hidden gems, companies with really low price-to-earnings or price-to-book ratios. It also lets you tap into industries that are kind of sleepy at home but are absolutely booming somewhere else. And hey, it can even act as a natural hedge if your own home currency starts to weaken.
And this slide, this is a perfect example of what I'm talking about. In the US, you've got industries like steel and cement. They're mature, they're cyclical, not exactly exciting growth stories. But then you look south to Latin America. Those same industries are fueling massive development. A company like Mexico Cemex delivered incredible returns for a long time. Why? Because it was literally building the infrastructure for a growing economy, while its American cousins were kind of stuck in the mud.
You know, that dynamic we just saw with Cemex, it's driven by a really powerful economic force, and it's called convergence. It's a pretty simple idea, really. Developing countries just tend to grow faster than developed ones as they play catch-up. And while we usually think about this with emerging markets, it's a much bigger principle. Back in the late 90s, this exact same force led to huge returns in places like Spain and Ireland as they got more integrated with the rest of Europe.
And check this out. This is where currency can become your best friend. Let's say you invest in a European company and it has a solid year. Its earnings grow 10% in euros. That's pretty good. But during that same time, what if the euro gets 5% stronger against the dollar? Well, for you, the American investor, that 10% gain just magically became a 15% gain. The currency move basically gave your investment an extra boost for free.
Okay, but it's not all smooth sailing and tailwinds, right? Of course not. Every expedition has its challenges, and investing abroad comes with some well-known risks. But here's the cool part. For a disciplined Graham and Dodd investor, these so-called headwinds can actually become hidden opportunities.
You know, the number one fear people have about investing overseas is this idea that you're just flying blind. There's this feeling that information on foreign companies is hard to get, it's not as frequent, and it's just not as trustworthy as what we're used to here in the US. And look, that seems like a huge, maybe even a deal-breaking disadvantage. But here's the kicker, and this is so important. The very tools you're using, the whole Graham and Dodd approach, it was literally built for this exact kind of environment. That intense focus on the balance sheet, on hard assets, and numbers you can verify is like a superpower in a world with less information. So where everyone else sees fog and just throws up their hands, you see an edge. That information gap creates inefficiency, and that's where a value analyst can really shine.
All right, so we've seen how a strong foreign currency helps your returns when you bring them back home. But here's a little twist. What if the company's home currency is actually weak? I know, it sounds like a bad thing, but for certain companies, especially ones that sell their stuff around the world in US dollars, it can be a massive hidden advantage.
This table shows exactly how this magic trick works. Let's imagine a company that sells its product for 10 US dollars. In year one, its costs are 35 units of its local currency. The exchange rate is 5 local units to 1 US dollar, so its costs are $7, leaving a nice $3 profit. Simple enough. Now look at year two. The local currency gets a lot weaker. Now it takes 10 local units to equal $1. The company's costs are still 35 local units, but now that only translates to $3.50. The sales price stayed the same, but its cost base just got cut in half. The result? The net income in US dollars more than doubles to $6.50. The company got way more profitable just because its home currency got weaker.
Okay, so we get the why, we've looked at the risks. Now for the practical part. How in the world do you actually buy these stocks from your living room without hopping on a plane? Well, for most of us, the answer is a simple but really powerful tool called an American Depository Receipt, or ADR for short.
Think of an ADR as basically a claim check. A big U.S. bank, like Citibank, goes and buys a massive block of shares in a foreign company, holds them in a vault in that country, and then it issues these certificates here in the U.S. that represent those shares. And you can buy and sell that certificate on the New York Stock Exchange or NASDAQ in U.S. dollars, just like you would trade shares of Apple or Ford. It's that easy.
Now, not all ADRs are the same. You can think of it like a ladder of accessibility and transparency. Level 1 is the most basic, traded over the counter, kind of the Wild West. Level 2 steps it up a notch with more disclosure, and these can be listed on the major exchanges. And then you have Level 3, which is the whole shebang. They have to provide full SEC-level disclosure, which means they can raise money directly from U.S. investors.
So at the end of the day, what ADRs do is just get rid of all the annoying logistical headaches. They handle the currency conversion for you, they make sure your dividends get paid you in good old US dollars, and they follow all the standard US rules. They basically put the world's stock markets right inside your regular brokerage account.
All right, our passport is stamped and we're ready to go. Now for the fun part. Let's take a quick spin around the globe and see where a Graham and Dodd investor might have actually found some of these opportunities, starting in good old Europe.
So let's start in Europe. In these mature, established markets, value is often found in classic heavy industry, the big, complex companies. Think about the UK, with those quintessential Graham and Dodd plays like British Steel, where the tangible assets on the balance sheet gave you a huge margin of safety. Or pop over to France, where you might find opportunities in a company like Aventis that's unlocking hidden value from all its different parts. And of course, Germany, the industrial heartland, with giants like Daimler and BAS that just periodically fall out of favor and get really, really cheap.
Now let's head east to Asia. And a lot of people just think growth, growth, growth. But that's not the whole story. Japan, for example, has been a surprisingly fantastic hunting ground for value investors. For years, many established amazing companies like Honda or Hitachi have traded for cheap compared to their massive book values. In China, the real value has often been in the big, boring, stable, state-controlled utilities. And South Korea? Wow. After the big financial crisis in 1997, you had these incredible turnaround stories. You could buy industrial giants like the steelmaker POSCO for literally pennies on the dollar.
Now, this might surprise you, but according to our source material, Latin America is arguably the single best region for American value hunters. Why? Well, it punches way above its weight in the number of ADRs you can buy, its markets are often more value-oriented than growth-oriented, and hey, it's right in our backyard. We're talking about iconic companies like Telmex, Cemex, and Petrobras. All have been accessible, profitable plays for U.S. investors at one time or another.
And to round out our trip, let's head way down south. Markets like Australia and South Africa are deeply tied to natural resources, and that means one thing: they are super cyclical. Their fortunes rise and fall with global commodity prices. This creates these incredible waves of opportunity for any investor who's patient. In one decade, when commodity prices are low, maybe the banks are the bargain. But when a commodity boom inevitably goes bust, the giant mining companies themselves, like BHP Billiton, can fall out of favor and become fantastic long-term value plays.
So, we've been all over the map, right? From the factories of Germany to the mines of Australia. Let's pull back for a second and bring it all home. What does all of this increasing interconnectedness mean for the future of how we invest?
I mean, you can't deny it. The world is just moving toward more and more economic integration. You've got trade agreements like NAFTA, you've got massive currency unions like the euro. The walls between national economies are just coming down. And what that's doing is causing not just the economies, but also the stock markets and their valuations to start looking a lot more like each other over time.
And this really brings us to the crucial question we have to leave with. Benjamin Graham's whole philosophy was built on this one core idea: the margin of safety. It's our ultimate protection against being wrong. But in a world where capital can fly across borders in a split second, and all these economies are converging, what does a true margin of safety really look like today? How do we have to adapt that timeless principle to make sure we're still protected for the century ahead?
We tend to think of Wall Street and Main Street as two completely different worlds. But what if I told you that the secret playbook used by stock market legends like Benjamin Graham and David Dodd could actually be your best tool for investing in real estate? Today, we're going to shift our thinking. We're going to stop seeing a house as just a home and start seeing it for what it really is: a powerful financial tool.
All right, so to really get why real estate is, well, such a unique beast, let's just put it in context. If you look at it next to stocks and bonds, something pretty incredible pops out. You get the safety and income you'd expect from a bond, but you also get that growth potential, that appreciation that gets everyone so excited about stocks. But look at that last line: leverage. That right there is the secret sauce. It's a total game changer, and it puts real estate in a league of its own.
So here's the plan. We'll talk about why it's like a stock-bond hybrid. Then, the big one, leverage. We'll get real about the risks. Then we'll crack open the Graham and Dodd playbook on finding value. And finally, we'll touch on how to get in on this without becoming a landlord.
All right, first up, this idea of a stock-bond hybrid. It sounds great, right? The best of both worlds. But let's dig into what that actually means and how it all works.
Okay, so the biggest mental shift you have to make is right here. A property, it's not just bricks and mortar. You have to start thinking of it as a financial instrument. I mean, think about it. It kicks off income through rent, right? That's your bond-like feature. But at the same time, the whole thing can grow in value. That's your stock-like feature. It's this one-two punch that makes it so powerful.
And this is where it gets really interesting. When you add up both of those streams, the income and the growth, the numbers are frankly pretty amazing. The cash you get from rent is usually way higher than what you'd get from stock dividends. And when you tack on the appreciation, well, historically, real estate's total return has actually beaten stocks by 2, maybe 3% a year. Now, that might not sound like a huge number, but trust me, you compound that over a couple of decades, and it is a massive, massive advantage.
So that brings us to the real engine of this whole thing. It's how fortunes are made in real estate, but it's also where the biggest danger lies. I'm talking about leverage. If there's one concept you have to understand, it's this one.
And look, this isn't some new trick. Even Andrew Carnegie knew it. He said buying and owning real estate was the fastest way to get wealthy. Why? Because you can use borrowed money to control a huge asset with just a little of your own cash. It's a powerful wealth-building tool. On Wall Street, they call it OPM, other people's money. And in real estate, pretty much anyone can use it.
And you don't need a finance degree to get it. We're just talking about a standard mortgage. You put 20% down, the bank puts in the other 80. So for every $1 you put in, you're controlling $5 of real estate. That's 4-to-1 leverage. It's right there, available to pretty much anyone who can qualify for a home loan.
Okay, so this is where the magic really kicks in. Let's just do the math real quick. Say you put $20,000 down on a $100,000 house. The house goes up in value by, let's say, a pretty normal 7%. That's a $7,000 gain. But remember, you didn't put in $100,000. You only put in $20,000. So that $7,000 gain on your 20 grand, that's a 35% return on your money. 35%! That's the power of the leverage multiplier.
But, and you absolutely have to hear this, this is a massive double-edged sword. That same power that juices your gains can absolutely crush you on the way down. Let's say that house goes up by 20%. Your 20K in equity becomes 40K. Boom! You've doubled your money. 100% gain. Amazing! But what if the house value drops by 20%? That 20K loss doesn't just sting. It completely wipes out your entire investment. Gone. A 100% loss. You've got to respect that downside.
Okay, so that leads us right into the, let's call them reality checks. Because leverage is the big financial risk for sure, but owning a physical building has its own set of headaches that can scare off even experienced investors.
Yeah, I mean, you can't just click sell like you do with a stock. It can take months to get your money out. It's illiquid. And the cost to buy and sell, they're huge. We're talking commissions, fees, taxes. Plus, it's a job. You're a manager. Toilets break, tenants call. And the biggest sin of all is negative cash flow, where you're paying out more than you're bringing in every month. You let that go on too long, and you're staring down the barrel of foreclosure.
And you have to remember that the environment for real estate isn't static. It changes. Back in the post-war boom, it was a pretty straightforward path to building wealth. Then in the inflationary 70s, it was all about using debt as a hedge. But then you get to the 80s and 90s, leading into the 2000s, and it was all about easy credit. And that easy credit completely flipped the script for buyers.
This comparison here is just fantastic. It lays it all out. Look at the 1920s example. A smart purchase meant your income easily covered your mortgage. You had positive cash flow. Simple. Now, jump to the 2000s. The prices were so inflated and the mortgages were so big that even with higher rents, your mortgage payment was more than the income the property generated. You were losing money every single month from day one. That's not investing. That's just gambling that prices will keep going up forever.
So, with all these risks, how do you actually do it? How do you find real value and not get caught in these traps? Well, this is where we open up the Graham and Dodd playbook. It's all about discipline and, frankly, looking for deals in places most people ignore.
Look, the best deals aren't going to be the perfect-looking houses on Zillow. The real value is found with what you might call motivated sellers or don't-wanters. We're talking about people going through a big life change, a divorce, a bankruptcy, a job relocation. They need to sell, and they need to sell now. Their problem becomes your opportunity. That's where you find a property for less than it's actually worth. That's your margin of safety.
And this brings us to what is, without a doubt, the number one most important rule. You cannot break this rule. The money you bring in from rent has to be more than all of your expenses, including the mortgage. It has to be. If it's not, you're not an investor, you're a speculator. The property has to pay for itself. Period. Full stop.
I love this quote. It's from way back in the 1920s Florida land bubble, and it just nails it. This real estate is for trading, not for owning. If your whole plan relies on finding a greater fool to buy it from you for more money, you're just trading. A real investor buys an asset for the cash it produces, not just because they hope it'll be worth more tomorrow.
But let's be real. Not everybody wants to be a landlord.
Who wants to get a call about a broken toilet in the middle of the night? So, is there a way to get the financial benefits of real estate without all the hassle? The answer is yes. There are other ways to do it. The easiest way is something called a REIT, which stands for Real Estate Investment Trust. Just think of it like a mutual fund, but instead of stocks, it owns buildings, big office buildings, apartment complexes, warehouses, you name it. And the best part? You can buy and sell shares of these companies just like any other stock.
And the perks are pretty obvious. REITs are legally required to pay out most of their income as dividends, so the yields are usually pretty high. They're totally liquid, you can sell in a second, you're instantly diversified across tons of different properties in different places, and you've got pros managing everything. So yeah, you get the income, you get the exposure to real estate, but none of the landlord headaches.
So at the end of the day, it all comes down to this one question. Is real estate a path to wealth, or is it just a path to a whole lot of debt? The answer is it depends on you. The tool of leverage can build you a fortune, or it can wipe you out completely. The difference, the thing that separates wealth from ruin, is discipline. It's buying for value, demanding positive cash flow, and always respecting the incredible power of debt. Thanks for joining me.
You know, being 45, I've seen enough market ups and downs to know that chasing the next hot stock, that's a fool's errand. The real game changer, the decision that actually shapes your financial future, is something way more fundamental.
The big one, right? Stocks or bonds. If you get this mix right, you're pretty much halfway there. But if you get it wrong, well, no amount of clever stock picking is going to save you. This one decision has more impact than anything else. So today, we're going to unpack two powerful and really different philosophies for getting it right. All right, let's start at the beginning with the godfathers of value investing, Benjamin Graham and David Dodd. You know, in a world that's obsessed with predicting the future and timing the market, they created this timeless defensive strategy built on one simple principle: discipline. So here was their genius idea. They created a kind of safe zone for how much stock you should own. The rule is incredibly simple but so powerful. Never let your stock exposure drop below 25% and never let it go above 75%. Now why? Because this isn't just some arbitrary rule. It's like a psychological fortress, and it's designed to protect you from your own worst enemy, yourself.
See, this isn't a random range. It's a set of guardrails against your own emotions. Think of it like a seesaw. When the market is flying high and everybody's feeling euphoric, these rules force you to take some profits off the table. And when things look grim and everyone is running for the exit, they force you to have the guts to buy. It's basically a built-in contrarian strategy.
Okay, so you might be asking, how did they know when to lean in or pull back? Well, this was their signal. It was simple, it was elegant. It just asked, are stocks offering a better deal than bonds right now? They'd look at the dividend yield, the actual cash that stocks were paying out, and compare it to the yield on a super safe top-tier bond. If stocks were paying a competitive income, that was a clear, logical sign that you were being paid enough for the extra risk you were taking.
Okay, so that's the classic playbook. Now let's jump forward a few decades and see how that approach got a major update. We're going to look at a more modern, much more active strategy from an investor named Michael O'Higgins, who took those core principles and really adapted them for a faster, more complicated world. This right here, this is a huge insight from O'Higgins. He pointed out that, yeah, stocks probably win the marathon over 30 or 40 years, but there can be entire decades where bonds are actually the smarter place to be. He argued that just buying and holding stocks might mean you sit through a whole lost decade of zero returns. The real trick, he said, is knowing when to make the switch.
And this slide, this really nails the key difference between the two. Over on the left, you've got Graham, who was focused on dividends, the actual cash in your pocket. But O'Higgins, on the right, he modernized that signal. He used a company's total earnings yield, which is basically just the flip side of the PE ratio. So in simple terms, while Graham looked at the payout, O'Higgins looked at the entire profit-making power of the company. That's a huge shift, especially now when a lot of great companies reinvest their profits instead of paying them out. So what this does is it creates this super simple, easy to understand traffic light for your money. It's a binary, all or nothing signal. Green light, you're 100% in stocks. Red light, you're 100% in the safety of bonds. It is a way more aggressive, tactical approach that tells you when to hit the gas and, maybe more importantly, when to slam on the brakes. So we've got two really powerful but different philosophies on the table. Graham and Dodd's disciplined, more passive approach, and O'Higgins' active, tactical one.
Now let's talk about the tools and the history that bring these to life, and show why you might just need both in your toolkit.
And this timeline, man, it just proves that there's no silver bullet. No single strategy works forever. The economic weather, it changes. And what works in one era could be an absolute disaster in the next. I mean, just look at that post-war growth era. Amazing for stocks. But if you use that same exact playbook during the stagflation of the 70s, you got crushed. Every era demanded a different approach.
So this brings us to one of the actual tools in the toolkit. When O'Higgins' traffic light turned green for stocks, what exactly did he buy? Well, one of his favorites was this classic value strategy called the dogs of the Dow. The whole idea is that the stocks in the Dow with the highest dividend yields are often the ones that are the most beaten down and unloved by the market. So by buying these dogs, you're basically betting on a big comeback from some blue-chip companies that have just fallen on hard times.
And the results of this tactical approach? Well, they speak for themselves. I mean, just look at this chart. Over a 30-year period that had some really brutal markets, his strategy of switching between bonds when the signal was red and a focused stock strategy like the dogs when it was green, it generated an 18% annual return. It didn't just beat the market, it absolutely trounced it.
Okay, so we've talked a ton about market theory, historical data, all these powerful signals, but honestly, the most important piece of this entire puzzle, it isn't in some textbook or on a market chart. It's you.
And speaking from my own experience, navigating life for the past 45 years, I can tell you for a fact that these abstract market rules mean very little if they don't sync up with your personal financial reality. A red light from the market doesn't matter a whole lot if you've got a tuition bill due next month.
Life just happens, right? In these big moments, they completely change your financial picture. Every single one of them shifts your goals, your timeline, and honestly, how much risk you can even stomach. Trust me, the way you invest when you're saving for a down payment is worlds away from how you invest when you're staring down college tuition for your kids.
So just take a second and look at this list. Seriously, where are you right now? Because your answer to this question is way more important than any market forecast from any so-called expert. It dictates the real-world rules for your portfolio and how much risk you can actually afford to take, no matter what the signals are telling you.
So here's the bottom line. A truly solid, durable strategy isn't about picking a side, Graham versus O'Higgins. It's about creating a hybrid. It's about taking the timeless discipline from the classics, grabbing the tactical flexibility from the modern signals, and then filtering it all through a really honest understanding of your own life's journey.
And really, that's the real question of asset allocation. It's not some set-it-and-forget-it decision you make just one time. The market is always a moving target, and so are you. The best strategies are living, breathing things designed to evolve. And that's a question that is absolutely worth thinking about long after this explainer is over.
When it comes to investing, there's this huge debate that's been raging for almost 100 years. It's a real clash of titans. On one side, you have the old school, roll-up-your-sleeves approach of Graham and Dodd. And on the other, you have the complex, data-driven world of modern finance. So let's get right into it.
It really all boils down to this one big question. Do you think the stock market is kind of a messy, inefficient puzzle? A place where, if you're clever enough, you can find incredible bargains that everyone else has missed? Or do you think it's a perfect machine where every scrap of information is instantly baked into the price of a stock? And believe it or not, how you answer that question basically puts you in one of two major camps. And these two camps have been battling for intellectual supremacy for decades. In this explainer, we're going to unpack the story of these two powerful and completely opposing philosophies. All right, so first up, let's talk about the original detectives of Wall Street, Benjamin Graham and David Dodd. Their whole approach, really, is based on common sense, incredibly detailed investigation, and, frankly, a healthy dose of skepticism about whatever the latest market craze is. A core belief for these guys is something called reversion to the mean. Now, it sounds complicated, but the idea is actually super simple. Think about it this way. If you have two really, really tall parents, their kids are probably going to be tall, but maybe just a little bit shorter than them, a little closer to the average height. It's the same with stocks. A stock that's trading at some crazy high valuation or a crazy low one will eventually, over time, drift back towards its long-term average. It's like financial gravity. So, if you believe that, how do you protect yourself while you're waiting for that reversion to happen? Well, that brings us to their most famous concept of all, the margin of safety. It's such a simple but powerful idea.
You figure out what a business is truly worth, its intrinsic value, and then you insist on buying it for way, way less than that number. The goal is to find stocks that are priced so darn cheap they just don't have much further to fall. It's your built-in cushion in case you're wrong or just get unlucky.
And that idea perfectly illustrates how they thought about risk. For Graham and Dodd, risk isn't just the stock price bouncing up and down day to day. That's just noise, that's volatility. No, for them, real risk, the thing you have to avoid at all costs, is the permanent loss of your money. It's when a stock price falls off a cliff and there's just no realistic way it's ever coming back. And that leads to a really critical distinction they made. An investment, in their eyes, is when you do thorough analysis and you can be reasonably sure you'll get your money back plus a decent return. You're buying a business based on what it's worth right now. Everything else, well, that's just speculation. It's betting on where a stock price might go tomorrow. It's a totally different game and a much, much riskier one. Okay, so now let's switch gears completely and talk about the other side of this debate. If Graham and Dodd were the detectives, then these next folks, they were the scientists. This is the modern finance model, which came out of universities in the middle of the 20th century. Their view wasn't about digging through company reports. It was about math, it was about statistics, and the wisdom of the crowd. So the absolute cornerstone of this whole philosophy is the efficient market hypothesis. The argument goes like this. At any given second, a stock's price already reflects every piece of public information out there. All the earnings reports, all the news, all the analyst ratings. It's all baked in. And if that's true, well, you can't consistently find undervalued stocks because they just don't exist. The market price is the right price. So the game isn't about beating the market. It's about figuring out how to manage your risk inside of it. The modern finance folks said, look, risk isn't just one big blob. There are actually two types. First, you've got unsystematic risk. This is the stuff that's specific to one company. A key product fails or the CEO gets into trouble. The good news is you can almost eliminate this risk just by diversifying, by owning a whole bunch of different stocks. But then there's systematic risk. This is the big stuff: recessions, wars, interest rate hikes, things that affect the entire market. You can't diversify that away, but you can measure it. And that measurement is called beta. This chart here does a pretty good job of showing how it works. Just imagine each of those little dots is, say, a month. You plot how the stock did that month against how the whole market did. Then you draw a line of best fit through all those dots. The steepness of that line, the slope, that is the stock's beta. It's a purely statistical number that tells you how volatile a stock is compared to the market as a whole. So what does this beta number actually tell us? Well, if a stock has a beta of exactly 1, it means it tends to move right in line with the market. Market's up 10%, the stock's up about 10%. Now, if the beta is greater than 1, say for a high-flying tech stock, that's what they'd call an aggressive stock. It's going to move more than the market in both directions. And if the beta is less than 1, like for a steady, boring utility company, it's defensive. It's less volatile than the market. Okay, so this all comes together in something called the Capital Asset Pricing Model, or CAPM. This line you're seeing here is called the security market line. And the theory is actually pretty simple. In an efficient market, the only way you can expect to earn a higher return is by taking on more of that market-wide systematic risk. In other words, by buying stocks with a higher beta. This line basically shows you the fair price for taking on risk. If you want more potential reward, you got to move up and to the right on this chart and just accept more volatility. No free lunch. So now we've met our two challengers. In one corner, you've got the value detectives, and in the other, the market scientists. So let's put them head-to-head on the biggest questions in all of investing. First up, the most fundamental question of all. What even is risk? And man, their answers could not be more different. For Graham and Dodd, it's a real-world concept, the chance that you will permanently lose your hard-earned money. For modern finance, risk is just a number on a spreadsheet. It's beta. It's a statistical measure of volatility, and that's it. Okay, how about the ultimate goal? Can you beat the market? The value detectives would shout a resounding yes. Of course you can. Their entire worldview is built on the idea that markets get emotional, they get irrational, and they make mistakes. And that creates bargains for patient investors who do their homework. The market scientists, they say no. The market is just too efficient. Anyone who beats it for a while is probably just lucky. And this brings us to an absolutely brilliant quote from Graham's most famous student, Warren Buffett, that just cuts right to the heart of this whole thing. He says the academics were right, that the market is usually efficient, but their big mistake was jumping to the conclusion that it is always efficient. And as he puts it, the difference between usually and always is like the difference between night and day. That's where all the opportunity is for a value investor.
So, last question, how do you actually build a portfolio? Well, the modern finance approach leads you to one logical conclusion: broad diversification. If you can't pick winners, then the smart thing to do is own a little bit of everything. You eliminate that company's specific risk, and you just capture the market's overall return. The Graham and Dodd school, though, argues for the exact opposite: concentration. They'd say you're much better off owning just a few businesses that you understand inside and out and that you bought with a massive margin of safety than owning 100 companies you know almost nothing about. All right, so after going through this whole debate, this huge clash of ideas, where does that leave you? This isn't just some academic exercise. Picking a philosophy, one that you can actually stick with, is probably the most important part of any successful investing journey. Let's just boil it down one last time to the key differences, right? It all comes down to how you see the world. Is the market a place filled with opportunities, or is it a perfectly efficient machine? Do you get returns by finding things the market has mispriced, or by taking on more market risk? Is risk about losing your money forever, or is it just about price swings? And finally, is safety found in a huge discount to value, or in owning as many different stocks as you possibly can? Ultimately, the choice is yours. It really comes down to which one of these worldviews you think is closer to the truth. And just as important, which one fits your own temperament. Are you wired to be a patient detective, sifting through clues that everyone else has missed? Or are you a data-driven scientist who trusts in the overall efficiency of the system? But let me leave you with one last kind of provocative thought to chew on. In economics, there's this idea that the biggest profits go to whoever owns the scarcest resource. And in today's world of high-speed computers and complex algorithms, maybe the scarcest resource of all is just old-fashioned patience and business-like discipline. Maybe the simple, conservative value investor is in the smallest group, and maybe that's the greatest advantage of all. All right, so you've read the books, you've seen the formulas, and on paper, value investing theory just makes so much sense, right? It's clean, it's logical, but what happens when all that beautiful theory collides with the messy, chaotic, and totally unpredictable real world? Well, that's exactly what we're going to dig into today. We're talking real case studies, the big wins, the painful losses, and the lessons you only learn from being on the front lines. And this quote, man, it really says it all, doesn't it? An investment strategy is just a bunch of nice ideas until you see the results. It's only as good as the money it actually makes, or loses. So today, we're tasting the pudding. We're looking at what really happened with these investments to figure out what separated the home runs from the strikeouts. Now, before we get into the nitty-gritty of these stories, let's just hit a quick reset on the main idea here. We're not trying to be fortune tellers, predicting the future. We're more like business detectives. Our whole job is to find $1 worth of a company that's on sale for 50 cents. And that gap, that 50-cent discount, that's everything. That's our cushion, our fortress, that's the famous margin of safety. So here's our game plan for today. We're going to see these principles in action. We'll look at some really great wins, and then, and this is probably the most important part, we're going to get real honest about the misses. And at the end, we'll wrap it all up with 4 lessons that are, well, pretty timeless. Okay, let's dive right in. How does this philosophy actually go from the page of a textbook into a living, breathing portfolio? Well, it all starts with looking in the places everyone else is ignoring and seeing potential where other people only see a bunch of problems. And honestly, what better way to get this than to look at some of the wins? These are the exciting stories. We're talking about finding absolute treasure in what the rest of the market thought was a junk pile. It's all about spotting that fundamental strength that's just been temporarily buried by some bad news. Our first one here is a classic comeback story, Pioneer Financial Services. Now, this was a small insurance company with, let's be honest, a pretty sketchy past. And that right there is precisely what created the opportunity. I mean, just look at this. On the surface, Pioneer looked like an absolute disaster. It had lost money, it had to publicly admit its accounting was wrong, and the stock just got hammered. For 99% of investors, this is a 5-alarm fire. You see this many red flags, you don't walk, you run for the hills. But this is where a value investor starts to get really interested. You start digging. Those accounting problems? Turns out it was a one-time thing. The core business itself was still a money-making machine. And here's the kicker, the part that gets really interesting. Look at the management. The top execs owned a third of the entire company. Their own fortunes were tied to its success. That's what you call skin in the game. And what were they doing? They were buying back their own stock like crazy. It was the loudest possible signal they could send that they knew the shares were an absolute steal. So while the rest of the market was in a full-blown panic, you could get in for as little as $5.25 per share. Now think about that for a second. The stock was so cheap, it was trading for about 4 times what the company earned in a year. That means you'd basically earn your entire investment back in profits in just 4 years. That is just an incredible bargain. The margin of safety was huge. And here's the payoff. Just a couple of years later, another company saw the exact same value hiding in plain sight and bought Pioneer out for $28 a share. That is more than a 5x return on the investment, a true home run. And it was all because the focus was on the reality of the business, not the emotion of the market. Okay, next up, let's talk about Dell Computer, back in '96. Now, I know what you're thinking, a high-flying tech company, how is that a value stock? But that's exactly the point I want to make. These principles, they apply everywhere, even in the sectors you'd least expect. So back in 1996, the entire tech industry kind of hit a wall. Everyone got nervous, investors got spooked. But Dell was a totally different animal. Its direct-to-consumer business model was revolutionary, and its return on equity was a jaw-dropping 30%. Because the whole industry was under a cloud, it created a fire sale for one of the best companies in the world. You could buy this incredible, fast-growing business for a 50% discount. It was sitting right there on the bargain rack. But this one came with a really powerful and kind of humbling lesson. The stock was sold for a 50% gain, which, hey, is great. You'll take that any day of the week. The problem? The real Dell growth story was just getting started. By selling early, a further mind-boggling 500% gain was left on the table. So here's the crucial lesson. The value discipline worked perfectly. It got you in at an amazing price. But a lack of conviction, a lack of patience, meant leaving the party way, way too early. And that leads us perfectly into the misses. You know, it's really easy to sit here and talk about the winners. But I'm telling you, you learn so much more from the investments that go wrong or from the big ones that you just let slip right through your fingers. A little humility goes a long way for an investor. So let's talk about Wells Fargo in 1990. This is just the ultimate cautionary tale about the battle between short-term greed and long-term vision. And what's crazy is, it started out as a brilliant investment idea made right alongside Warren Buffett himself. This timeline just tells the whole painful story. You get in at $50 a share on the fall. A few weeks later, it pops up to 55. And the temptation is just too much. You sell, you lock in a quick 10% profit, and you pat yourself on the back. But then you have to watch as the stock just takes off like a rocket, blowing past $100, even while the bank was still reporting bad news. By grabbing that tiny little win, the massive, life-changing opportunity was completely and totally missed. And this quote just says it all. The analysis of the bank's short-term issues was actually correct. But Buffett's analysis of the bank's incredible long-term staying power, that's what really mattered. He had the patience, the conviction to hold on through all the bad news. And that was the key. A very tough lesson learned the hard way. Now, check this out, because this is a really subtle but important idea. Not all misses are the same. You have good misses and bad misses. Look at International Aluminum. On paper, it looked cheap, but it was a classic value trap. It was cheap because it was a bad business with bad management. So avoiding that one, that was a good miss, a smart decision. But then you have Woolahan Lumber. Also looked cheap, but underneath, it had amazing shareholder-friendly management and it was a cash-generating machine. Passing on that one was a bad miss, a true hidden gem that got away. The key difference wasn't the price. It was the quality of the business and the people running it. So after all these stories, the good, the bad, the bittersweet, what have we learned? Let's try to boil all this down into our final section, a clear, simple framework of lessons that you can actually use. It really seems to come down to these 4 pillars. Number 1, you have to start with a balance sheet. That's your foundation, your margin of safety. Remember British Steel? It was selling for less than the cash it had on hand. Number 2, you have to assess management. Do they think like owners? Are they on your side? Pioneer and Woolhoan showed us that's absolutely critical. Number 3, you've got to understand the long-term picture. You have to see past the temporary noise, like with Dell, and focus on the real earnings power of the business. And finally, number 4, maybe the hardest one of all, patience. That's the brutal lesson of Wells Fargo. Finding the great business is only half the job. Having the conviction to just sit tight and let it work for you, that's where the real magic happens.
And that really leaves us with this final thought to chew on. We live in a world of high-speed trading, constant news alerts, a world that is just screaming at us to do something, anything, right now. And in a world like that, maybe the single greatest competitive advantage you can possibly have is the discipline to just slow down, to ignore all that noise, and to focus on the simple, timeless task of figuring out what a business is actually worth. Maybe that's always been, and will always be, the ultimate edge.
All right, let's set the scene. The year is 1999. Pets.com is a thing, dial-up is screeching, and tech stocks are going to the moon. It's the absolute peak of the dot-com bubble, and the old rules of investing feel completely broken. So what would happen if, right in the middle of all that chaos, you decided to go all in on a super old-school, hardcore value investing strategy? Well, we're about to find out, because we're going to follow one investor's wild year-long experiment in real time.
You know, the legendary George Soros had this concept of a real-time experiment, basically testing his big ideas with real money on the line. And that's exactly what we're looking at today. We're tracking an investor who took their own retirement account and used it as a laboratory to ask a simple question. Could the classic stodgy principles of Graham and Dodd actually survive in one of the most irrational markets in human history?
So here's how we're going to break this story down. First, we'll set the stage for this wild experiment in 1999. Then, we'll dig into the fascinating strategy they used to navigate a bull market. After that, we get to the good stuff, the actual trades month by month. We'll see what happened when the Nasdaq just went completely vertical. We'll check out the final scorecard, and maybe, most importantly, we'll unpack the huge lessons from what happened after the bubble finally burst.
Okay, so the setup here is pretty simple, but man is it bold. The investor is using a real money, tax-deferred IRA account. What's cool about that is there's no money coming in or out, which makes it a perfect little petri dish for our experiment. And the philosophy? Not just any value investing. We're talking a full-tilt, hardcore, by-the-book version straight from Benjamin Graham and David Dodd, the godfathers of value investing. This brings us to where things stood at the end of 1998. And this is a big one. The investor had just sold a huge long-term position in, wait for it, Berkshire Hathaway. I mean, think about the guts that takes, deciding that even Warren Buffett's masterpiece had gotten too expensive. And that one decision left the portfolio in a super defensive crouch, holding a massive 30 to 40% in straight cash. Can you imagine the discipline? Just sitting on all that cash while it feels like your neighbors are getting rich overnight on some dot-com stock you've never even heard of?
So the game plan was basically broken down into 3 buckets. First up, you've got asset plays. This is classic deep value, finding companies like Flynn's Basement that were literally trading for less than their assets were worth. You know, buying a dollar for 50 cents. Second, dividend yielders like British Steel, which was paying a crazy 12% yield at the time. And third, fallen growth stars. Think of a company like Callaway Golf, once a market darling, but it stumbled, and now it's in the bargain bin. This was never about finding the next Amazon. It was about finding solid, boring, and most of all, cheap businesses.
And this, right here, this is the core of our story. It's the big question. How on earth does a logical, disciplined investor even hope to compete when the market has thrown logic completely out the window? How do you stick to your guns when everyone else is getting rich doing something that feels, well, completely insane? The answer, and you're going to love this, comes from ancient military strategy.
To really get the mindset here, you have to hear this classic riddle from Sun Tzu's The Art of War. Okay, so a king has 3 horses. His rival also has 3 horses, and they're all of equal strength. It's a best-of-3 race, so how can the king guarantee a win? If you just race your best against his best, second against second, it's a coin flip. But Sun Tzu, well, he had a much smarter way.
The solution is it's brilliant in its simplicity. Instead of trying to win every race, you strategically sacrifice one. You take your worst horse and race it against their best horse. You know you're going to lose that one. You accept it. But then you take your best horse against their second best and your second best against their worst. You've just guaranteed a 2-to-1 victory. And the metaphor for investing here is so powerful. You have to be willing to lose in the short term, to look wrong in a crazy market, to set yourself up for a guaranteed long-term win.
All right, so enough with the theory. How did this actually play out in the real world with real money? For the first 9 months of 1999, while the market was still, somewhat tethered to reality, this disciplined approach was working like a charm. So the year kicks off with some classic, unsexy value plays, betting on beaten-down industries like oil services and steel.
In April, a stock called Morgan Products, which was bought below its asset value, gets sold for a beautiful 70% gain. And then get this, by June, the portfolio even finds value in the tech sector of all places. It's a company called Viasoft, and it had been absolutely obliterated, falling from over $60 a share down to $4.50. At that price, it was a classic value play, trading for less than its book value.
But being disciplined, well, it comes with its own kind of pain, doesn't it? The investors sold a company called Case Corporation in the low $30 because, according to the numbers, it was fairly priced. It wasn't a bargain anymore. Well, shortly after, a buyout offer comes in at $55 a share. And that's a tough pill to swallow, right? It's so easy to look at that and think, man, I left all that money on the table. But the whole point of the discipline is selling when it's not cheap anymore, not trying to guess if some corporate hotshot is going to come in and overpay.
And the source material gives us the perfect cautionary tale for this, the story of Snapple. Quaker Oats, the so-called smart money, paid $14 a share for it, and it was such a disaster, such a massive overpayment, that the executive who pushed the deal through eventually got fired. It's just a fantastic reminder that just because a corporate buyer is willing to pay a premium, like that $55 for Case Corp, doesn't make it a good price. You have to stick to your own valuation.
So, with all this discipline, all this boring old-school investing, how is he doing? Well, by the end of July 1999, boom, the portfolio was up 23.9%. Now, to put that into perspective, if this IRA had been a mutual fund, that performance would have ranked it number 1 out of 388 funds. And he did it while sitting on a mountain of cash. The strategy was absolutely crushing it. But you know something's coming, right? The market was about to change.
And here we go. This is where the story takes a dramatic turn and becomes a true test of nerve. As the final quarter of 1999 kicked off, the market's love affair with tech stocks turned into an absolute, full-blown mania. And in just 3 short months, the entire investing world got turned completely upside down.
Now, to really get how nuts the next part is, you have to see this number first. For the first 9 months of the year, 3/4 of the year, the S&P 500 was up a measly 3.8%. It was a flat, boring, sideways market for most big companies. And against that backdrop, this value portfolio's 20-something% return looked like pure genius.
But then, this happened. The NASDAQ finished the year up 84%. I mean, that's just an unbelievable number. And a massive chunk of that gain came in a frantic, speculative frenzy in the last 3 months of the year. The entire game had changed seemingly overnight.
So the big question is, how did our disciplined, slow and steady value portfolio hold up against that kind of pure, unadulterated euphoria? Let's look at the tail of the tape for 1999.
This table tells the whole story of that final quarter so perfectly. Just look at the lead over the S&P 500. At the end of September, the value portfolio is ahead by a massive 16.5 percentage points. He's cruising. Then October hits, bam, the lead gets sliced in half. November, it shrinks again, and by the time the dust settles in December, the tech tsunami had completely washed that lead away, and the portfolio actually finished the year lagging behind the index.
So here are the final results. The value portfolio returned 15.9%. The S&P 500, supercharged by that tech mania, finished up 21%. So on paper, yeah, the experiment lost to the market. But, and this is a huge but, you gotta look at the context. That 15.9% return absolutely destroyed what the average value investor made that year. They only got about 6%. And remember, this was done with one arm tied behind his back, holding 40% cash. That's an incredible performance in that environment.
But you and I both know the story doesn't end on December 31st, 1999, right? I mean, a single year, especially a year as crazy as 1999, doesn't really prove anything. The real test, the real vindication of a philosophy, comes from what happens next.
And would you look at this? After the bubble burst, these boring, forgotten stocks that nobody wanted came roaring back. Jim Bory, the kids' clothing store, turned into a 4-bagger. Stewart & Stevenson tripled. One company just liquidated itself and paid shareholders out more than they paid for the stock. And here's the ultimate punchline. In the year 2000, as the NASDAQ and S&P 500 were getting absolutely crushed, this portfolio was up 19%. That Sun Tzu horse race strategy, it worked. It worked perfectly. Now, let's be real. Value investing isn't magic, and it wasn't all sunshine and roses. The experiment had its share of duds and cautionary tales. Allied Products went bankrupt, poof, a total loss. Safeco turned out to be a classic value trap. Hancock Fabrics was sold in frustration right before it went to the moon. We've all been there, right? And remember Case Corporation? The company that bought it ended up in financial trouble, which just proved that the $55 buyout price really was too high all along. It's a powerful reminder that even with a sound philosophy, things get messy.
So we end with this question. This whole experiment, this incredible story from over 2 decades ago, it provides such a powerful lesson for today. When it feels like everyone around you is getting rich on the next big thing, and your own disciplined, logical approach feels lonely and outdated, is that the moment of maximum risk, or is it the moment of maximum opportunity? This story makes a pretty darn strong case that it's the most valuable and ultimately most profitable place you can possibly be.
You know, cast your mind back to the late 1990s. The internet was this brand new, world-changing force, right? Fortunes were being made hand over fist, it seemed, and the stock market felt like a one-way rocket ship to the moon. Everybody had this feeling, this conviction, that the old rules just didn't matter anymore, that we'd stumbled into some kind of permanent new age of prosperity. But here's the thing. If you listen real close, you can hear history whispering. Turns out, we've definitely seen this movie before. And understanding that past, well, that's the only way to make sense of the madness. All right, let's get into it. To really wrap our heads around these crazy cycles of euphoria and, well, despair, we're going to tackle this story in 6 parts. We'll kick off with that dot-com frenzy, then we're going to pull back the curtain on what the market even is. After that, we'll see how the Dow has changed, compare stock prices to real, tangible value, look at a whole century of booms and busts, and then, at the end, we'll pull out the one lesson that never, ever gets old. So our story really starts in the late 1990s. It was just a time of unbelievable optimism, all of it powered by the rise of the internet. It really felt like a completely new world, a real paradigm shift. But as you're about to see, that feeling, it has a very familiar and maybe a little bit of a cautionary echo from the past. Just let that sink in for a second. That was the confident call from one of the most respected economists in the country, just a few weeks before the historic, catastrophic market crash of 1929. The idea that this time is different is just so powerful. It's so seductive. And it's an idea that popped up again with incredible force 70 years later during the tech boom. This was the number. This was the summit. The Dow Jones Industrial Average hit its peak, 11,497, at the very end of 1999. And for so many people, this wasn't just a number on a screen. No, it was proof. It was the ultimate validation that the internet, globalization, all this new technology, it had fundamentally torn up the old rulebook of economics. The new era was here. I mean, why bother with old school stuff like profits when you could measure eyeballs? Who cares about book value when you could dream about this amazing digital future? But look, to really know if the rules have changed, you first have to understand the game. And you have to understand the scoreboard everyone was obsessed with, the Dow itself. So that brings us to our second part. Let's actually dig in and see how this incredibly influential number gets put together. Because it turns out, the market that you hear about on the news every single day, it might not be what you think it is at all. Okay, so this is the most important thing to get. The Dow is not some natural scientific measure of the US economy. It's really just a curated list, a pretty exclusive club of 30 companies picked by journalists. And it has this really important quirk. It's price-weighted. All that means is that a company with a high stock price has more sway than a company with a low stock price, no matter how big the actual company is. And this is where things get, well, a little weird. Let's say a company's stock is at $200 a share, and they do a simple 2-for-1 split. Now the price is $100 a share. Now the company's total value hasn't changed one bit, but its influence on the Dow, it just got cut in half. Think about that. The index that everyone holds their breath over can be seriously skewed by a simple accounting move. Now, what's truly fascinating is that the story of the American economy is basically written right into this hand-picked list of 30 stocks. If you just watch how the members of this club have changed over the decades, you get this crystal clear picture of our economic past. So let's compare 2 different snapshots in time. The Dow that the great investor Benjamin Graham was looking at back in the early 70s was a completely different animal than the one that grabbed the world's attention in the late 90s. The whole cast of characters had changed. Just look at this list. Gone are the absolute titans of industrial America. You know, the steel companies, the copper miners, the guys making farm equipment. And in their place, the giants of tech, big box retail, and media. And then you have American Can, a classic smokestack company, which, through a bunch of mergers, basically morphed into a piece of the financial giant Citigroup. This tells the whole story of the hollowing out of industrial America and what replaced it. The market isn't some fixed thing. It's a living, breathing story. Okay, so if the Dow is this ever-changing group of companies, and its value can be jerked around by things like stock splits, how in the world are we supposed to know what it's actually worth? How do we separate the hype from the reality? Well, luckily, the guys who invented value investing gave us a tool for exactly that, a reality check.
It's called investment value, or IV for short, and it's a purposely simple, super conservative formula. Its job is to cut through all the noise, all the market chatter, and get to a baseline of what a business is fundamentally worth. It's based on two real things: the company's hard assets, its book value, and the actual cash it pays back to its owners through dividends. It's a number that's grounded in reality, not hopes and dreams.
So, let's use this new tool to look at two totally different moments in market history. We've got the pessimistic, fear-driven market of the early 70s, and we'll compare that to the euphoric, greed-driven market of the late 90s. And the results, well, they're pretty eye-opening. Just take a look at these numbers from 1971. You've got these major industrial powerhouses, the bedrock of the American economy, and they were trading at massive discounts to what they were really worth. Anaconda Copper was going for less than 28 cents on the dollar of its investment value. U.S. Steel was at 36 cents. This was a market just gripped by pure fear, where investors were basically giving away solid companies for pennies. All right, now let's jump forward to 1999. The picture is the complete polar opposite. The darlings of the so-called new economy were trading at just insane premiums to their investment value. Microsoft was priced at over 2,000% of its IV. Home Depot over 1,000%. This wasn't investing anymore, not based on tangible value. This was pure speculation. It was a bet that prices would go up forever just because they'd been going up.
Now, this wild swing from deep pessimism to just irrational optimism, that's not some modern thing. It's a pattern that has repeated itself over and over again throughout market history. So for this next section, let's zoom out and take a look at the bigger picture, the unforgiving cycle of booms and busts. History shows us at least three of these enormous, once-in-a-generational peaks. You have the Roaring '20s, which of course ended in the crash of '29. Then you have the go-go years of the 1960s, which led into a long, painful bear market. And then, of course, the dot-com bubble. And every single one of them was powered by some new technology or a new way of thinking. And every one of them came with that same old belief: this time is different. This slide right here, this really puts into perspective how extreme that 1999 peak was. Using our investment value tool, we can actually put a number on the speculative fever. So in 1928, right before the Great Crash, the Dow was trading at a 65% premium to its fundamental value. In 1968, at the top of that bull market, the premium was a pretty modest 16%. But in 1999, that premium had exploded to an unbelievable 237%. The market wasn't just detached from reality, it was in a completely different solar system.
And you know what's incredible? The warning signs were there, and they came from the very top. The chairman of the Federal Reserve himself asked this question way back in 1996, when the Dow was only at 6,400. He saw that the market's excitement was getting unhinged from reality. But when you're in a full-blown mania, nobody wants to hear the warnings. The market went on to almost double from the very point he sounded that alarm. Okay, so we've seen the new era hype. We've taken apart the Dow, and we've put the dot-com bubble into its historical context, this century-long pattern of booms and busts. So for our final section, let's pull it all together and figure out the timeless lesson in all of this. This is the big one, isn't it? When the price of the market flies hundreds of % above its real, underlying worth, what happens next? History doesn't give us guarantees, of course, but it does show us some very clear and, frankly, very sobering patterns. Based on these historical cycles, the source material makes a pretty chilling projection. The pattern suggests that after these huge generational peaks, like in '29 and '66, the market doesn't actually get back to its old high in real inflation-adjusted terms for nearly 30 years. And after the crash, it eventually hits a bottom that's way below its fundamental value. So if you apply that same pattern to the peak in 2000, it points to a potential bottom for the Dow all the way down at 1,500, a level where the price would be just half of its underlying investment value, which is eerily similar to what happened at the market bottoms in 1932 and 1974.
And that, right there, brings us to the ultimate lesson. The companies in the Dow change. The technologies that power our world, they change. The excuses for why this time is different always change.
but the core principles of value, and maybe more importantly, the patterns of human psychology, that incredible, powerful swing between fear and greed, those things stay remarkably and often painfully the same from one generation to the next. History may not repeat itself perfectly, but boy, does it rhyme.
All right, let's get right into it. Today, we're going to dig into a theory that's, well, it's pretty unsettling. It takes a hard look at the very foundation of our modern global economy. And the argument here is that all this prosperity, all this growth we've been enjoying for decades, it isn't built on solid rock. Nope, it's built on something a lot more precarious, a massive, teetering pyramid of credit. And that's exactly what we're going to unpack.
And this quote just nails the core idea, doesn't it? For decades, the real engine of wealth wasn't what we could actually make or produce, but what we could borrow. The theory we're looking at suggests the global economy has been on, let's call them economic steroids, for years. And now it's about to feel the after effects. All those overvalued markets we saw, well, maybe they weren't the dawn of a new era after all, but the twilight of an old one.
So where did all this trouble begin? According to our source material, the first cracks in this giant credit structure didn't actually show up in the West. The alarm bells really started ringing overseas first, exposing some deep weaknesses long before they hit home.
Yeah, the first real tremor was the Asian financial crisis back in 1997. You had these countries that were being hailed as economic miracles, Thailand, Indonesia, South Korea, and then suddenly, bam, they were forced to devalue their currencies. This was a huge shock because a lot of these places were export powerhouses, so what on earth went wrong?
Well, it turns out that Asian economic miracle wasn't quite as miraculous as it looked. The whole model, as you can see, was basically built on governments pushing companies to take on mountains of debt, with the unspoken promise that the state would back them up. This led to a whole mess of problems: crony capitalism, huge investments in projects that were never going to be profitable, and just incredible waste. I'm talking Malaysia trying to build the world's tallest building. That's like a textbook sign of hubris right before a fall. The entire system was only as strong as the governments guaranteeing all that bad debt.
And this wasn't just some isolated event. It was like a line of dominoes tipping over. The contagion started to spread, and it lit up a different but still related set of problems down in Latin America. And their proximity to the United States created its own unique and pretty dangerous dynamic.
See, unlike the Asian exporters, a lot of Latin American countries were running deficits across the board in both trade and their current accounts. The source calls this a demonstration effect, basically a deep desire to import and live an American-style life, but without the economic engine to actually support it. And this just led to one currency crisis after another, like in Mexico and then Brazil, as they just couldn't get their fiscal house in order. There's this old saying from a Mexican president that really sums it up. Poor Mexico, so far from God, so close to the United States. So as if all that turmoil in emerging markets wasn't enough, one of the world's biggest economies was already deep in a crisis of its own. Japan's decade-long stagnation was a really critical piece of this puzzle, and in a lot of ways, Japan itself was the catalyst for so many of the problems brewing across Asia.
Just to get a sense of the scale of this thing, look at this comparison. Back in the 1980s boom, Japan's top banks became absolute monsters. They just dwarfed their American competitors. And they were so flush with cash from their own success at home that they started lending massively, aggressively, and, let's be honest, foolishly all across Asia. They were the ones who financed all the overbuilding of factories and property that would later come crashing down, creating a ripple effect that destabilized the entire region.
So you see all these cracks showing up overseas, but they were really just symptoms of a much deeper problem. Because while the trouble appeared abroad first, the core argument here is that the United States itself became the real center of the problem. Not the victim, but the actual epicenter of this incredibly risky global imbalance.
Just look at that number. A trade deficit running at nearly $500 billion a year. This is the heart of the matter. America basically became the world's consumer of last resort. We were the ones buying up all the exports from the rest of the world, providing the cash to keep the whole system running. But this created a massive, and I mean massive, unsustainable imbalance. And this whole setup is what the source calls a Faustian bargain. It's a deal with the devil, right? America gets to live way beyond its means, consuming more than it produces. And in return, all those export-heavy economies in Asia and Europe get the one customer they absolutely need to keep their factories humming. On the surface, it looks like a win-win, this perfect circle. But it's a circle where just one broken link could cause a total avalanche. So you have to ask, how could Americans possibly afford to be the world's shopper? Simple.
a massive explosion in domestic credit. All this financial sophistication, ATMs, targeted marketing, you name it, made it easier than ever for people to borrow money. The system wasn't just making it easier to spend, it was actively encouraging it on a scale we'd never seen before.
And here's where it just gets, frankly, absurd. This is a real anecdote from the source material. Get this, in just 6 months, one guy got pre-approved credit card offers in the mail for his 4-month-old son, his dog, and his computer, because it had a screen name. And why? Because they all had excellent negative credit histories. In other words, they had no record of ever defaulting on a loan. Of course they didn't. It's a perfect, almost comical example of how the most important part of making a credit decision, actually evaluating someone's character, was completely thrown out the window.
So it really forces us to ask a pretty basic question. Was all this the peak of financial sophistication, or was it just a system designed to encourage reckless behavior? The author argues that lenders were using all these fancy marketing tools to get people to take on loans they probably couldn't afford, knowing full well what the risks were, and then just relying on the legal system to collect when things went bad. It was a system built on profitegy.
And this is where we get to the most unsettling part of this whole analysis. The argument is that this isn't some new, unique story. Nope, we have seen this movie before, and it has a devastating ending. We just need to look at Japan's recent history and even go all the way back to the lead-up to the Great Depression.
I mean, look at this timeline. It's chilling. It lays out Japan's journey perfectly. Decades of incredible success, followed by a massive asset bubble, then the crash, and then a long, painful period of stagnation they call the lost decades. The argument here is that the United States at the turn of the century was just following the exact same script, maybe a decade or so behind. That last question mark for the USA? Well, the author suggests the answer is pretty much inevitable.
So, the big question is, why can't the smart people in charge just stop this from happening? Well, here's the paradox. The source compares economic managers to generals who are always experts at fighting the last war. They've learned all the lessons from the 1920s, and they've got all these tools to manage smaller crises. But their very success is what creates this dangerous overconfidence.
And this is the result. It's a wild idea. Because everyone believes the central bankers can step in and put out any fire, it actually encourages people to take on even crazier risks. It allows these bubbles to grow way, way bigger than they ever would have otherwise. So, in this view, the success of modern economic policy doesn't prevent a crash. It just guarantees that when the crash finally does come, it will be so much bigger.
And that leads us to the final, pretty sobering conclusion of this whole analysis. If this cycle really is inevitable, what does that downturn, that final phase, actually look like?
Well, here's one way it could all play out. It could start with central banks finally getting nervous and trying to tap the brakes. That move would immediately make lenders pull back on credit. And without that fuel, consumer spending, the engine of the entire global economy, would just grind into reverse. From there, the international dominoes start to fall. Money stops flowing between countries, trade dries up, and the whole beautifully interconnected system starts to unravel, fast.
The source material really doesn't pull any punches here. The most likely outcome, in this view, isn't some mild recession we can bounce back from, no. It's a scenario that looks a lot like the 1930s, major stock market crashes that trigger a devastating global depression. It's a stark and, let's be honest, deeply troubling forecast.
And so that's where we're left, with this one fundamental question. After all our learning, with all our sophisticated modern tools, can we actually get rid of the business cycle for good? Or, and this is the scary part, does every attempt we make to smooth out the bumps and keep the good times rolling just build up more pressure somewhere else? Does it just delay the inevitable, guaranteeing that when the reckoning finally comes, it's far, far worse? That is the disquieting thought at the very heart of this entire analysis.
You know, sometimes it feels like the stock market has a personality, right? Like there's this hidden rhythm, this secret pulse to its big booms and its long busts. Well, today we're going to dig into a really fascinating theory, one that says the key to understanding all that isn't just in the economic textbooks, but in something way more personal. It's about us. It's about our generations. I mean, we've all seen it. We've all lived through it. You get these incredible stretches where it feels like the market can only go up. And then it's followed by years of just going sideways, treading water. So what if the answer isn't just in the charts and the data? What if it's actually about sociology? What if it's about who we are?
You know, even the greats, like Warren Buffett, have pointed out these massive long-term patterns. He's the one who talked about the cycle of 17 fat years followed by 17 lean years. But the source we're looking at today, which comes from a book on Graham and Dodd Investing, it offers this really unique and kind of mind-blowing explanation for why these cycles actually happen.
So here's the core idea. The theory basically says that these huge, sweeping market cycles are driven by the alternating power of different types of generations. It's not just about things like interest rates or earnings multiples. It's about the collective personality of the people who are running the show.
This theory, which builds on some amazing work by William Strauss and Neil Howe, suggests that American history kind of toggles back and forth between two different types of generations taking the reins in their midlife. First, you have what they call dominant generations, the ones who run the economy in overdrive. They spark these huge booms. Then you get recessive generations who kind of come in to rein things in, to clean up the excesses and manage these long periods of correction. And these two types, dominant and recessive, they play out in this recurring four-part cycle. Each one is basically a reaction to the generation that came right before it. So you have the visionary, moralistic idealists. They're followed by the pragmatic, get-it-done reactives. Then come the community-building heroic civics, who in turn raise the more cautious, risk-averse adaptives. It's this continuous, predictable rhythm playing out over and over again.
Okay, now this is where it starts to get personal. Look at how this maps out a recent history. You've got the heroic GI generation, the civics, then the adaptive silent generation. After them, the visionary boomers, the idealists. And then you get to my own generation, Gen X, the pragmatic reactives. You can literally find yourself, your parents, your kids on this chart and see how you fit into this grand repeating pattern. It's pretty wild stuff. So if the theory is right, if this is a real pattern, then we should be able to look back through history and see these same generational pairings creating really similar historical moments. These echoes. If you use the same ingredients, you should get a pretty similar cake, right? Well, the author of our source material points to a very specific generational combo that creates something called an inner-driven era. This is what happens when you have an elder idealist generation providing the big picture vision and a midlife reactive generation that's actually running things with this individualistic freewheeling style. And the argument is that this exact mix has twice now led to these massive technology-fueled stock market manias.
So the claim is that this special inner-driven generational mix leads to tech bubbles. Let's really put that to the test. The source draws this absolutely stunning parallel between two of the most famous bull markets in history, the Roaring '20s and the dot-com boom of the '90s. This right here is where the theory gets incredibly compelling. Just look at this. It's almost uncanny. In the '20s, you had the elder missionary generation, those were idealists, and the midlife lost generation, the reactives. Fast forward to the '90s, you have the elder boomers, idealists, and my midlife, Gen X, reactives. The exact same archetypes in the exact same life stages. And what happened? Both eras saw a breakthrough technology, radio, then the internet, that just captured everyone's imagination. Both had these market darlings, RCA and AOL, with insane valuations, and even the social vibe was similar, a kind of anything goes feeling. And the author makes this brilliant point. Both of these technologies were genuinely world-changing, no doubt about it. But the initial market frenzy, the bubble, that was driven more by this unique generational mood, this inner-driven spirit, than it was by any actual immediate profits. It was a mania fueled by a very specific sociological recipe. And this timeline here, this reveals a really crucial lesson from both of those eras. See, a new invention is almost never made profitable by the same generation that invented it. Radio was invented way back in the 1900s, but it didn't really become a solid business until the 1950s. Same with the internet, invented in the 70s, but the author predicted it wouldn't be broadly profitable until around now, the 2020s. The key is that it takes a new generation, the kids who grow up with the technology, to figure out how to make it a mature, money-making industry.
Okay, so this is where it gets really interesting, because if this cycle is real, it shouldn't just explain the past. It should be able to give us a forecast for the future. And based on this whole framework, the author made some incredibly bold predictions years ago. So right after that huge boomer boom of the 80s and 90s, the theory predicted a long period of lean years for the market. And why? Because the generation moving into its prime managerial years was my own,
Generation X, a recessive, reactive archetype, just like the lost generation that had to manage the aftermath of the 1929 crash. It was as if history was set to echo once again.
But the predictions go way beyond just the stock market. See, the full four-part cycle, from idealist to reactive to civic to adaptive, it takes about 80 years to complete. And according to Strauss and Howe, these long cycles, they don't just quietly fade away. They tend to build to a climax, a period of major society-altering crisis.
And here is where it gets kind of spooky, to be honest. These guys, Strauss and Howe, writing decades ago, they looked at this 80-year rhythm of American history, from the Revolution to the Civil War, from the Civil War to World War II. They followed that pattern forward, and the date they landed on for the start of the next great American crisis era? 2020. I mean, just let that sink in for a second.
So what did they think would trigger this crisis? This wasn't just some random guess. They actually laid out a very specific scenario based on the generational and economic trends they were seeing. Our source material, which was written back in the early 2000s, it painted this picture where massive economic imbalances could create the perfect storm for a major global confrontation. It specifically pointed to this dynamic of the U.S. as the world's biggest debtor and rising Asian nations, especially China, as the world's biggest creditors. That, they said, would create immense tension and challenge American power at all these key flashpoints.
And here's the critical piece. The theory predicted a specific generational mismatch for this potential showdown. By 2020, the U.S. would have elder idealists, the boomers, who are historically intolerant of challenges on their watch. And it would have young adult civics, the millennials, a heroic, can-do, war-ready generation. That is the exact same generational alignment the U.S. had going into World War II. Meanwhile, the theory predicted China would have a much less favorable Vietnam-era type of alignment.
So look, whether you buy this whole theory hook, line, and sinker or not, you have to admit it's a powerful and pretty provocative way to look at the world. It makes you ask the question, are we all just characters acting out a script that was written by the rhythm of generations long before we were even born? And if so, what does that mean for the chapter we're all living through right now?